Hi and welcome to the Small Cap Virtual Showcase. My name is Steve Torso and I'm the founder and managing director of Wholesale Investor. Today's event is brought to you not only by Wholesale Investor, but also our partners over at AusBiz TV and the Capital Network. And what's really important in the virtual environment is obviously trying to create as much visibility as possible. And it's great to have partners like them who are helping us create an extended reach for the companies which we are featuring today. Now, obviously, Wholesale Investor is quite well known for working with private companies, but we actually have a long history of working with exciting and innovative small cap companies as well. In fact, throughout our history, three of the small cap companies that we have worked with have gone on to become unicorns. One of those companies we were actually working with when they had a market cap of less than 10 million. And for us, that is what excites us about the journey of working with small cap companies, because often they are undiscovered gems sitting amongst the ASX that we can help bring out to our investor network that can get behind and actually support the companies. So as part of with the small cap, effectively what we are looking to do, we are bringing to you the range of companies that effectively you can engage with via our platform. So in a second, I'll get through how you can actually do that, how you can actually go through a Q&A process with the CEOs, but also how you can access some more information to learn about the actual companies themselves. During the event, we are going to be covering 10 companies. Those 10 companies we're going to be featuring range from a range of sectors such as life science, healthcare, mental health, fintech, technology in general, and also resources. And to give you an idea, as far as us from working with these companies, some of the companies that we worked with, for example, at our last emergence conference in late February, when we were going back through and looking at the performance of these companies, even during COVID, we noticed that 6 out of the 8 companies that we work with had experienced over 100% growth in that time. In fact, some of the rising stars that we've been able to work with, for example, Recce, over the last 12 months, that company has been able to perform over increase their share price over 640%. Or a company like Imugene, 3 years ago when we started working with them, I said they had a market cap around about the sort of 20-30 million mark, and just recently they crossed over sort of 250 million. And said that sort of stuff is what inspires us and what basically binds us to sort of wanting to work with more and more small cap listed companies. But for you as an investor, it's also why this is such an exciting space to work in. So also as part of today, not only do we want to bring you some exciting opportunities, but we also want to bring to you some information, education. We want you to learn from the people that are investing into this space, that this is what they do day in and day out. The fund managers that are actually investing into small caps themselves directly. So we have 2 panel sessions specifically. One is a fund manager panel session. The other is an IPO spotlight. And the IPO spotlight is something that I am super proud of, and I'll explain that in a second. And then we also have 2 strong keynotes, which I'll go through. So in the first panel session, we're really pleased to have, obviously, Lelda from the Capital Network, who's going to be the moderator. We've got James Posnet from the ASX, who's going to be talking about his observation and also what he's seeing for some of the companies that are going from IPO to actually being listed. We've got Monique, who's the Chief Investment Officer at Instinct Funds Management, and Richard Ivers, who's from Prime Value Asset Management. So for me, that's an exciting session to host because it gives you an insight into what the fund managers are actually looking at right now in this space. And then one of my favorite sessions and one of the ones I was most proud to basically bring together is an IPO spotlight. Each of the companies in this session, whether it be you're looking at 4D Medical, whether it's Otomo Diagnostics or Aroa Biosurgery, have previously been clients of Wholesale Investor. In fact, what I get passionate about with Wholesale Investor is that we often get the opportunity to work with companies right through their life cycle. From often sometimes the seed stage or really the early stage, right through to pre-IPO to IPO and then to being listed on the stock market. And these three companies have been fantastic examples of what is possible, and they've been able to prove themselves in COVID. In fact, Otomo Diagnostics was one of the first companies to list on the ASX after the sort of first COVID wave in March, and they listed in the ASX. And you know, that's a company that's got sort of support and has received funding from, example, the Bill and Melinda Gates Foundation. But said, fantastic success stories that we have seen their journey over 5 to 7 years unfold. So I get the opportunity to host a panel session and you get to learn some insights directly as to what it's like for these companies to go through that actual journey. As I mentioned, we've got two fantastic keynotes, one with John Diddams. John Diddams is probably one of the most proactive and most senior people in the markets that works with companies taking them from private to listed on the exchange. To give you some perspective, in the last 10 years, he has been involved as a director and on the board of listing over 20 different companies. And then one of the most highly regarded and renowned fund managers in Australia, Jun Bei Liu, who's part of the Tribeca Alpha Plus Fund, is absolutely phenomenal. We've had Jun Bei participate in our events before and ends up being a standout for attendees that comes to our event in the insights and the approach and the ways that she's looking at markets. And what's also unique about their fund is they take both a long and also short approach as well, being able to capitalize off the volatility. As I said, it's a fantastic interview and a fantastic session. Now, how you actually engage with the event is actually via Chris. So you have received a link. We encourage you to create an account. It's completely free. And what that means from you is you can actually engage directly with the CEOs via your CRISP account and also via the channel, right? So every company, you have the ability to click onto the YouTube link. We will be providing the links to get access to the deal rooms and also to the speakers of each presenter. And also they're going to be making themselves available to have discussions on our YouTube channel as well. We have done our best to make this as simple as possible. Firstly, for you to access the video, or access the content, and then secondly, to engage directly with the actual presenting companies themselves. Now, as part of building our ecosystem, how we do this is through you. Wholesale Investor has been able to grow via word of mouth. And you know, in doing that over the last sort of 11, 12 years, we've been able to reach multiple countries and now represent, you know, our investor base represents over 30,000 high net worth professional investors from around the region. And we would love to keep on growing that because we know the more we grow our ecosystem, the more we get involved, the more opportunities that get created. And at the end of the day, that is what sits at the core of our company is how do we create opportunities for tomorrow. So on a final note, thank you very much for joining the Small Cap Virtual Showcase. I hope you enjoy the event. Engage with the companies that are presenting. I hope you enjoy the special panel sessions and keynotes that we've set up for you as well. I look forward to speaking with you shortly.
To begin today, I would like to introduce our first keynote speaker, John Diddams, principal of JFDCPA. He will be presenting his insights around managing a successful IPO.
For this next session, I'm doing an interview with John Diddams, who's probably Yeah, from my perspective, I've been in this space for quite some time, and I've watched John. He's worked with over 20 IPOs over the last sort of 10 years. So this session's really all about how both founders and investors can really get behind the successful listing of a company on an exchange. So this session's really been driven around, the title of it is The Keys to Managing a Successful IPO. I'm joined by John Diddams, so please welcome and say thank you, John.
Thank you. Thanks for having me. Appreciate it.
So just to start with, do you want to give a bit of a background to yourself?
Yeah, sure. Well, going way back, I did a cadetship with John Lysart. I did accounting part-time at university, worked for a while and then went overseas, spent 6 years in London working for an American oil company over there in their internal audit. Came back, joined an entrepreneurial guy, and we then started doing a few listings in the early 80s. I was the centre of it, doing all the mechanics of it, and they had all the ideas. So I learned a lot from these guys. By the early 90s, I thought to myself, yeah, I seem to do all the work but not get most of the reward. So I went out on my own, hung out my shingle and as a CPA, and started doing work on floats and other things. I employed a number of people in those days and did company secretarial work and accounting work and other stuff, as well as doing some listings and so on. I did find, though, after a few years that I spent more of my time administering those people and doing administrative without doing the stuff that I like doing, which was actually managing the process for an IPO. So for the last 15 or so years, I've been on my own and managed the IPO process for, as you say, 20 plus companies, and I thoroughly enjoy it.
And to give context, like what are some of the names of the companies that you've sort of been on the board of and helped successfully list on the Australian Stock Exchange?
Okay, well, going from most recent.
Like most recent,
the most recent was a New Zealand company out of Auckland called Arrow Biosurgery. They have a wound healing a medical device. They're operating in the United States. They wanted to list on the ASX as opposed to the NZX, and they contacted me through some other contacts. And
just to note, we're actually featuring them in our IPO Spotlight session as well.
Oh, good. Well, you'll like Brian. He's the CEO.
He's actually an old client of Wholesale Investor. We worked with him sort of back in 2012, 2013. So great to see that sort of process of building, and then successfully listing.
Well, that was quite a successful listing. It was 75-cent shares came on at $1.40. So that doesn't happen every time, I'm going to tell you. But there were some peculiar things about that. We were going to go to the IPO in March, pulled it because of COVID, then had conversations between ourselves and the brokers and the potential investors, and we put in place a pre-IPO cap raise of 18 million on the proviso that within 3 months we did an IPO, and we pegged that too, so we had a 20 million guaranteed into the IPO. So that all worked really well once we got a bit of settling down on the COVID thing. Prior to that, the reason I was introduced to that one is I'm director of another company called Volpara, which is another New Zealand company out of Wellington, and they are in breast care and breast density and helping clinics to manage their process and their reporting to FDA and so on and so forth. So that's been very successful at IPO as well. I'm not just in the medical space.
Yeah, I was going to say.
I did the snoring and sleep apnea Somnomed float some time ago. I've done the indoor wind tunnel for iFly.
Indoor skydive,
I did a lot of reconstruction work with Skydive the Beach, which was a outdoor skydiving operation in Wollongong. We had to firstly reconstruct the whole company to undo all of the shareholdings and put them under one umbrella, and then make a public company, and then so on.
We'll get on to how you sort of help these companies in the structuring part.
So I tend to now. I used to do work as a consultant, but now I tend to find that it's better to be a director of the company. And the reason for that is it's better for the company. Because the CEO and the CFO and so on can continue running the business of the company. They've never done an IPO before, so it would be folly for them to try to run the process if they've never done it. They'd fall into all the little traps and so on. Whereas I've done as I said, 20-something. So I know the pitfalls, and I know the brokers, I know the lawyers, I know what's required for ASIC and ASX, I know the listing rules. So I manage that process for them as a director. And as a director, I share their responsibility, liability. I get full visibility, transparency of all the issues and so on. And then I take most of my reward in the way of equity, so I align my interests with that of the shareholders and the directors. And then I generally stay on the company board for a few years to help them in that transition, which is quite a tricky transition between being a private company and being a public listed company.
Well,
so there's quite a lot to do.
So just on that, so let's go sort of right back to the start with some of the companies that you work with. So when you typically, when you're looking at a company that's going to go to IPO, typically how does it start? Do you have the management reach out to you? Do you have one of their shareholders typically reach out to you?
Look, it's a bit of a combination of all those things. In some cases, I've had the founder reaching out. In some cases, I've had the investor that's been investing in the company over a period of years that wants to then see an exit for their investment. And so they reach out. Quite often, it's a recommendation from another director. I don't do any advertising. I've never done any. And,
I've never seen an ad from you.
And it's all word of mouth.
And from the time you first meet a company, so say you sit down with a rower biosurgery or indoor skydiving, what is the typical time frame you're thinking about? Okay, I've just met this founder. What sort of time frame are they giving themselves to go through typically the IPO process?
Yeah, that's a really good question, and the two are quite separate. I mean, for example, with Skydive the Beach, for example, they had a lot of reconstruction to do. So we spent a good year reconstructing the business and putting in place processes, procedures and so on to be able to make them into a public company before we even started the IPO process. So it was almost a 2-year process.
So just on the details of that component, so are you helping them become a public unlisted company in the first step?
Yes, exactly. Yes, what they had, for example, I mean, I remember Bowie showed me his corporate structure when we first started, and it had 40 different companies on it, which owned drop zones and aeroplanes and people and hired people and so on and so forth. Now we had to bring all that together, and they're all different shareholders. It was himself and his mother and his trust and his super fund.
So it's almost like a roll-up.
So we had to do a complete roll-up of this business, as you say, and put it together. So that took quite a lot of doing. There were some other distractions along the way, but you know we got through that.
And how do you help the mindset of the founder? Because as you mentioned, it's a big gap going from being a private company to then public unlisted and then to listed. How do you help the founder sort of in understanding what they are, helping them mentally prepare for what they're about to experience going through?
That's interesting. It's quite a difficult process for a founder to get to understand that they've previously been running something that's all theirs, and now they're running something that they only own part of and that the public owns a part of. So they have to get across that mindset. But that's where I can help them, because I've done it so many times before.
You're the safe hands, right?
I sort of help. The most important thing is for the founder, the CEO, the CFO and so on to continue doing their job of running the business so that the business doesn't fall over while they're trying to do this process.
And that's powerful, right? Because if you think about it, as a founder and as a business owner, you're always sort of pushing new ground, you're breaking new territory. Often you've got no one to follow. So if you're going through an IPO process and you understand the ramifications of that, if it's done poorly or if it doesn't quite work out as expected, it's a concern. So I imagine going to you where you do have, you mentioned before, the brokers, the lawyers, it's like, okay, it's something that I don't have to think about, that if I didn't have someone like you on board that's got that sort of been there, done that experience. So for me, if you've got them focused on driving, on building the business, how are you helping understand their capital requirements that they'll need to go through the process?
Oh, that really comes out at the start. I mean, when I talk to the business, I find out what their aspirations are, and what do they want to do. Do they need capital to expand? Do they need capital for marketing? Do they need new products or whatever? So we work that out first. And then we try to work out, well, what is the business worth today?
And what's the process you go through?
And that process is generally on a like-for-like basis. You look at peer group companies and so on, and you try to determine a value. It's never a definitive thing. It's always within a range and so on. And it's more of an art than a science, to be honest. And then once you decide that, you then decide, okay, how much do we want to raise to be able to execute on that business plan? And then we work that out through, and then we go back to the brokers and see what they have to say.
So you said go back to the broker. So when you're trying to get that, okay, so trying to understand a sort of valuation of business, are you taking a few friendly brokers or fund managers? Okay.
Absolutely. You've got to get everybody on side,
Yep.
right from the start, and get everybody. I like to use the expression, get everybody in the same boat rowing in the same direction.
Yep.
Because if you've got one person that's out of order, then it doesn't work very well. And that includes the lawyers, the accountants, and you've generally got at least two sets of accountants. You've got the auditors, and then you've got the investigating accountants that look at the prospectus and so on. And then you might have the PR firm and so on. You might have an industry expert that you want to opine on that industry so that you can say, well, because if it's a complicated industry, you want someone to be able to distill all that for the average investor. Because a lot of these companies, a lot of businesses are quite complicated, but you've got to simplify it down. You've heard the expression, the elevator pitch. Well, that's what you've got to do. You've got to be able to tell them what it's about within 3 or 4 floors.
It's actually one of the hardest things as a founder is that you think about, you spend day and night building your business, but really when you go through even an IPO process, you've got to get it down to almost 3 bullet points, explaining sort of what you do. And then, obviously fund managers ask more technical questions and so forth, but it's one of the hardest things in the world trying to distill that simple message, the simple growth strategy, and also why you believe it will be a successful IPO.
And the other part of that too is that if you leave it all to the lawyers, and I'm not being disparaging about lawyers, they've got a very important role to play, you'll have a prospectus that's absolute boilerplate. But there's no story, and you can't sell it. Well, and if you leave it all to the PR people, you'll have this fantastic story, but I'm not sure that you'd really want to do that because of the liability that might come from some of the things. So my role is to try to bring those together so that you end up in the middle with a good story that's accurate and truthful and can be presented to investors, but at the same time, you're not going to have ASIC looking over your shoulder and saying, you can't say that or you can't do that. So, and then you've got to take it to the ASX and get it past the ASX as well.
Now, just before that process, okay, so you've gone out, you've got you've spoken to a few brokers, you're trying to understand what the valuation is. Let's say you've got your hands on a valuation range. Is there a percentage of the company that you're looking to raise capital for in the IPO? And are you often sort of thinking about a pre-IPO strategy that helps sort of build momentum into the IPO?
Yeah, that's a good question, but it all depends on the circumstances of the time. The valuations generally come out about where you think they're right. If you get a company, I'll give you an example, when Facebook listed, Mark Zuckerberg took $3 billion off the table and the float was pretty much a flop because the price went down afterwards. Now, I don't know about you, but I could probably live on $2 billion. So if he only took 2 and left a lot more on the table for the other investors, it would have been a much more successful float earlier on. It's come back now since then, obviously. But what you've got to make sure of is you make sure that what you're doing is fair right across the board for everybody. That the new investors are not putting their money into something when the founder or the old investors are taking it out. You don't want that. The new investors have got to be sure that some of that stock that the old investors have is escrowed so that they're not selling and running off on day one and so on. But at the same time, if someone like a founder has been working in the business for 5 or 10 years and he's mortgaged his house and done all these things to build this business, then you should allow him to be able to take some money off the table to fix his financial position because then he can be focused 100% on making the business more successful for all the new shareholders. So there's a balance there. And, I've seen it at all ends of the scale and, I think I've got a pretty good idea now of what that balance looks like.
Gotcha. And it said, whilst you said it's a balance, I imagine you've got a sort of typical sort of amount of equity you're looking to, as a percentage-wise, of the company you're looking to allocate for that process?
It's not necessarily a percentage. No? It's more to do with the business plan, and it's more to do with how much money does the company need to get it to execute its business plan. Now, there's if it only needs 20 mil, and let's say the company's worth, just for sake of argument, 100 mil pre-IPO, and you raise 20. If you can get that 20 million to make the company worth 200 million in 2 years' time, that's a great exercise because then everybody's benefited from the money going. There's no point going and raising 50 if you only need 20 and leaving 30 in the bank. There's no point, because what you've done then is diluted all the existing shareholders too much, and the new guys have come in, and all they're going to get is interest on the money. That's not.
Yeah.
So you've got to keep it as tight as possible, but have enough money to execute on the business plan.
And
so the percentages don't really matter.
And with the execution of the business plan, are you thinking across a 2-year period, a 3-year period, a 5-year period? Like, obviously, as far as the allocation of capital.
To me, it's a minimum of 2 years
Yep.
to see where the company's going to be in 2 years. And that might mean that the company needs to raise more equity in 2 years' time if it's kicked its goals. If it hasn't kicked the goals, then there's a problem. So you've got to make sure that, firstly, anything that you promise, you can deliver. So that's as the business. And then secondly, that you've got enough capital to make sure the business can run for at least 2 years to either get it to break even or get it to, cash flow positive, or get it to, double profitability or whatever. It's not the end of the world if you need to raise more capital down the track, if you've been able to kick those goals along the way.
Makes sense.
So there's no real rule there. That's
now, so you've.
water.
Sure, go for it.
Yep.
So basically, okay, so the next part of this is now going on the roadshow component, right? So you've got people in place, you've got your strategy in place. What sort of advice would you give for a founder or investors backing companies that are thinking about going through the IPO process? What would you think? What advice would you give them about the IPO roadshow process?
First thing is know your business. As a founder, you've got to know your business, but you also got to know how you can sell it to someone else. The business, not the product or whatever it is. And then you should also have next to you your CFO, who should have unbelievably good knowledge of his numbers. If he doesn't have good knowledge of the numbers, then the people start to worry a bit. You've got a good board, you put a good board around you. As I said, I always join the company as a director, but I rarely take on the chair role, because I'm more of a nuts and bolts, to roll up the sleeves and get the process managed. I like to have a chairman that can look at the big picture, the strategy, the industry, and so on and so forth, so that you've got that. And then another couple of 1 or 2 non-executive directors, and obviously with diversity and so on as part of that. And that gives you a good then balanced board of 4 or 5 or 6 people with different skills to take forward. But going back to your original question, that process, you have to make sure that you know your business inside out, because the investors, they'll know. They'll know what questions to ask.
And typically, what is it? Is it a month-long process? Is it a 2-month, 3?
No, by the time you get to that, I generally join a company, 8 to 10 to 12 months before it lists. Because there's a lot of work that's got to be done beforehand as well. Corporate governance work's got to be put in place, all the right structure, and so on. So you get all that done, and then you appoint your lawyers and your brokers and your accountants and everybody else to do the IPO. You start the process on the prospectus, and then you write the prospectus. Now the CEO is going to tell you the story, and then others are going to have input into how that story is told. But you've got to tell it in the most succinct way, but enough to get the message across, and as I said before, enough to make sure that you satisfy all the regulators, so that you don't end up with a problem afterwards.
Gotcha.
And half of that is down to the due diligence process itself. You start with a planning memorandum, and you work out this is the plan, and then you stick with the plan on the way through. You have, I generally have due diligence meetings every 2 weeks, same day, same time, Wednesday, 11 o'clock. 2 hours, and everybody that's got an interest in that comes as part of the due diligence committee, and then there's minutes produced, to-do list, and an outstanding issues list, and so on. So everyone knows where they stand. And then when I finish that meeting, I then give a report to the directors separately, so they know what's going on, because the directors are ultimately responsible for this prospectus. They have to carry the can if something's wrong. And if I'm a director, I'm going to make sure there's nothing wrong, because I'm sharing their responsibility and their liability. We've had supplementary prospectus in my time, but I've never had any prospectus of mine ever subject to any legal litigation whatsoever.
Gotcha. So now we're going to the process, and we're getting closer to the IPO. And There's a famous journalist that used to basically cover all the IPOs, and I remember having a chat with him, and I asked him what his advice would be for companies, and I remember him telling me he used to get really frustrated with CEOs because they would make all this noise and do all this talking and so forth, and they'd be happy to do interviews during the IPO process, but then after the company would be IPO, there would just be silence from them. So what guidance would you give to CEOs that after they've listed their business, how to manage that investor relations to not only keep their existing investors up to date, but to also attract future investors as well?
Well, that's very, very important. That's a very good question, actually. A CEO of a public listed company should spend a third of his time on investor relations.
Wow.
A third of his time.
Yep.
Spends a third of his time on the business and the other third of his time on managing all the people and so on and so forth. So, but a third of his time on investor relations, should have a good investor relations firm. You always set out a program before the event. So, you know, I can help with that so that everyone knows in the next 12 months what things you've got to put out to comply with the stock exchange regulations. And then you look at ASIC and say, well, okay, we've got to have an annual meeting here, we've got to have this here. You might have quarterly reports for the ASX on the cash reports if the company hasn't had profitability up to that point, so there's certain regulations there. And then you overlay that with, well, if it's, for example, a medical device company, when do you think you're going to get FDA approval for that particular thing? Well, we think it's going to be then, so there's a milestone. So we want to put that. Now, you don't go and overpromise. You don't say it's going to happen on the 1st of November, because if it doesn't, then everyone goes, whew, what's happened? So, but you say we're expecting that within the first half. And then when you get it, then you make that announcement. And so on. But you've got to be very careful not to overpromise and then under-deliver.
And I was going to say, life science is a hard one, because I've heard of so many different deals where they're literally waiting for sign-off on a contract, and the person that's signing off could be on holidays or something, and that's the reason it's delayed. Now, final question for this session. What are some of the key traits that you've seen in some of the most successful CEOs that you've worked with and gone through the listing process with?
Passion is the first. The passion for the business, passion for the product, passion for the service, passion for what they do. For example, you know, the most recent one, Brian Ward, the CEO of Arrowa, he's been in that business for 10, 12 years, and he is passionate, and he understands it, and he knows it, and he knows it extremely well. And that's contagious. That goes, permeates all through the thing. If you've got another one, I'm not going to mention any names, but if you've got somebody that's only there for the ride, that doesn't have that passion, you know, it soon gets found out, and it's not as successful. Not as successful.
Well, John, thank you very much for your time. So I appreciate to have someone of your experience and skill set join us for this session.
Thanks.
Look forward to having you on for future activities.
Oh, thanks a lot, Steve. I appreciate it, and enjoyed doing it. Thank you.
Thanks, John.
Our first presenter today is neuroCare Group, who are innovating mental health and performance by personalizing therapy, following a detailed assessment. With the current standard of practice being a one-size-fits-all approach with the use of drugs, the side effects often are unacceptable. Here to discuss this opportunity further is founder Thomas Merkenheimer.
Good day. My name is Tom Merkenheimer. I'm the founder of a company called neuroCare. We personalize mental health and performance. Our vision is to innovate mental health, and the personalized care we provide expresses itself in best-in-class clinical outcomes, but also best-in-class commercial outcomes. There is a real global crisis in mental health. The numbers are just staggering. And if you add sleep, stress, burnout, and mental performance, you're really facing hundreds of millions of people seeking proper help. The cost side of it is equally staggering. If you look at it in 2010, we spent about $2.5 trillion in the OECD countries for mental health issues. And by 2030, this is projected to be 16 trillion. That is really staggering. The real issue is that there's no satisfying solutions. A lot of the approaches are based on medication. Medications have side effects. Medications have a lot of non-responders, and medications don't work causally, meaning they don't really address the underlying issue. Psychotherapy or cognitive behavioral therapy does do that, does have the right approach, does work with what's called neuroplasticity, our brain's ability to learn, but they simply have the issue that they usually do not get paid enough sessions. So the outcome is often difficult to maintain. It's a bit akin you only trying for 5 times to learn to ride a bike or hit a tennis ball or hit a golf ball, and the outcome always will be doubtful. So what does neuroCare do different? In simple terms, we look much more detailed in what the underlying issues are. We look at more dimensions. We look at the brain's function. We do the normal psychodiagnostics. We look at your physical brain biomarkers. And most importantly, we look at your sleep. And from that, we personalize a therapy approach that also includes modern technology that simply amplifies and boosts your learning ability. This is why we achieve best outcomes. The underlying approach from a psychological perspective is called enhancing your self-regulation, instead of thinking or fooling us into thinking that we can eliminate a depression or an ADHD just like a broken limb. That's not the case. So self-regulation means that your outcomes are sustainable, and personalizing means that your outcomes are best. This is also evidenced when you look at our outcomes compared to the other approaches, and especially when you look at the therapeutic approach to the right. We have the most objective, the most causal, and the most focal approach. Please go onto our website and inform you more. I also want to share with you that neuroCare is the digital therapeutics company, because all the technologies we have to boost your ability to learn and to heal are, of course, able to be delivered remotely, both the assessment and the therapy, and we really include artificial intelligence and deep learning algorithms. I don't think I have to stress that these days, also partly driven by the COVID crisis, the regulatory hurdles and the market reception is much growing or changing. This is why in the long term, neuroCare will be akin to software as a service business, and why in the long term we have those two divisions. The clinics are our credibility. Here we cure 1,500 patients per year. And the solutions is basically offering all our technology services, training to third parties to do the same. Let's quickly look at the market. If you only think of the OECD countries and the countries we are already active in, the 15% mentioned here, and a very small market penetrations in the first 5 years, we already have a potential of 3.5 billion to be addressed. Most of what we do, the technology is used, is reimbursed in the big global markets. And also what we do is actually, because it's a one-term average 3-month, 30-session treatment, it's actually a lot cheaper than all the current approaches. We have surely assembled the world's best team. Please go onto our website. We have the technology leaders and pioneers, the management and the scientific leaders and pioneers in our team. You can see the 2 key people in management listed here. I myself am not only an electrical engineer and understand the technology, but I have spent 13 years in healthcare as a very senior executive, building vertically integrated business. And last but not least, probably most importantly for the subject matter at hand, I know the perspective as a patient as well. So what is neuroCare looking for? We're seeking growth funding only. You see to the left, the blue curve is the sales, the green curve is the EBITDA. We have now achieved EBITDA positivity in all clinics, and we have also break even in the solutions division on a very small base, and we foresee the group breaking even in 21. We have a big pipeline of identified projects for both clinics and solutions. So really the 5 million we are looking to raise are all for identified projects. We have a good strategic partner to explore the market potential, the huge market potential in Japan, and we will accelerate our digital therapeutics approach. Please come to us, please join us, please go onto our CRISP landing page, use the QR code and join us in making the world a better place. This is a true impact investment. Thank you.
Our next presentation today is from Rapid Response Revival, the innovators behind the Cell AED defibrillator technology. After identifying that sudden cardiac arrest has an extremely high death rate, They have designed the Cell AED to assist everyday people in emergency situations. Here to talk further about this venture is Non-Executive Director Simon Shields.
Hi, I'm Simon Shields, a Director of Rapid Response Revival. We've created a product that will change the way the world deals with sudden cardiac arrest. We call it the Cell AED. Our founder, Donovan Casey, had to deal with the sudden cardiac arrest of his wife in 2014. That got him thinking about how to deal with this problem. What is the problem? Problem is that for every minute that goes by, the chance of survival from a sudden cardiac arrest drops by about 10%. As time goes by, it's not just the chance of survival that falls, but also the amount of damage to the body is increasing. Sudden cardiac arrest is one of the biggest killers in Australia. About as many people die of it each year as of cancer, far bigger than the number of car accidents or the number of people that die in fires. It's very hard to deal with because you need an AED, an automated external defibrillator, but they're not located in the home generally. And 70% of sudden cardiac arrests occur in the home. And of course, if you're not trained on how to use one, they're very intimidating. At the moment, the market mostly consists of the government and paramedics, first responders. That's a good market, it's quite large as you'll see, but there's an untouched consumer market. And if we're going to solve the problem of sudden cardiac arrest, it's the consumers that are going to have to apply the AEDs. So this is the Cell AED. Unlike a standard common AED at the moment, it's much smaller, not much bigger than a mobile phone, it weighs about the same. It doesn't have pads that stick out in the same way. The pads are internal to the device. And unlike existing AEDs, it costs only about $150 versus $1,500. I'm using US dollars here because that's what the manufacturing costs are involved with. Now, for existing AEDs, you don't have to just buy the device up front. You've also got to replace the pads and the batteries. And that can cost around as much as our device costs up front. Now, we expect our device will get replaced regularly, to start with about every year or so. So it's a recurring business model. The benefit of using our device, apart from the fact that you don't have that big upfront payment, is that you're always getting a new device. Whereas existing AEDs, they're designed to be out in the field for years and years, even though they're getting the pads and batteries replaced, and the technology over time gets left behind. This is a personal device, a device that we can all have in our home, in our cars, in our offices. So how did we do it? Well, there have been some very big innovations in the device. Clearly, the cost is very low. How have we done that? We've integrated everything into the one device. You can see Snap Peel Stick is on the front of the cover of the Cell AED. So once you've snapped the device to activate it, you peel it, the pads are connected by a cable, you put it onto the body, you stick it, and it does the rest. We've been able to achieve this through miniaturization. There's been a lot of miniaturization going on with technological developments in all sorts of devices over the last 10 or 20 years. But where the real breakthrough is in our device is in the energy density of the components and the efficiency of the components, which we won't go into here. But we have made patentable breakthroughs in these things. We're also taking advantage of the Internet of Things and GPS so that we can exchange data with the device and we can locate the device. The other big breakthrough is the way we think about our device. Rather than a large device that can be used once and then have its pads and batteries replaced and used over and over again while it stays in a public area, our device is designed to be used only once, even though it can shock multiple times. That makes it a lot cheaper to make. We don't have to make it as robust. So what are the features? Well, the first feature is that it's easy to use. We've done human factor testing, and people that have had no training on this device pretty much pick it up and work out how to use it first time. It's also got audio prompts, which modern AED devices have. So once you've got it activated, it will start talking to you and talking through what you need to do and let you know what's going on. It will only shock if it detects a shockable arrhythmia, and it will shock multiple times if it needs to. It will communicate, if it has to, and tell the emergency services where you're located. It will record what's going on in terms of the data from the heartbeat and the shocks, so that it's there for the medical professionals afterwards, and they can actually see what happened to you, to the patient. And then finally, it does self-checks, and it communicates that self-check, and we communicate with it. So if it's not working, we can get onto it straight away. The current market for ADs has got 3 major players. It's a very large market, but these guys only have about 20% market share each. There's another 50 or so people that make AEDs globally. So the path to making them is a pretty well-worn one. We think, though, the market's actually a lot bigger than this, because at the moment, there is no significant consumer market for AED devices. We won't be addressing that market to start with. We're going to be looking at the corporate market as well. Governments, big corporates, transport companies, etc. And we've got distributors lined up already, not just in Australia and New Zealand, but in the Middle East and Europe. It's a large market, and these people have made commitments to us already. You can see the quality of some of the partnerships we have as we've built this business. The key partnership there on the left-hand side is Wavetronics. This is a local firm that has experience manufacturing electronic devices. There's 4 of us on the board of the company at the moment, including the 2 founders, Donovan Casey and Errol Tebber. As we head towards IPO next year, we'll be putting on another 3 high-quality, non-executive independent directors. The senior executive team has been built out and is fairly large, as you'd expect from a global medical device company. We're raising money at this time to help fund the commercialization of the device. We need about 10 million at the moment, and that'll take us into next year, and we'll be starting the path of IPO. We expect to IPO towards the end of next year. There are already 150 shareholders. The money we raise in this raising will go to a range of uses. As you can see, there's some clinical trials ahead, but more to the point, there's the commercialization and the working capital that's needed and the scaling of this business. So, milestones going forward. We have our clinical trials and then finalising our regulatory approvals, which we've been working on for a number of years. Our manufacturing at scale begins with Wavetronics in the new year, but we're already having devices roll off the production line, and we have commitments to deliver into New Zealand in March of next year. We expect to start scale manufacturing in Taiwan in 2021 as well. The company's achieved so many things so far, apart from regulatory certifications and orders, and distribution partners. We've got patents across the world and many more in train. We've got a significant medical advisory board, and we've locked in demand for over 3 million units. So now it's time to get involved. Join the shareholders we have as we head towards IPO next year. To get involved, look into our deal room through CRISP, use the QR code.
Our next presenter today is Montem Resources. Montem is a steel-making coal developer from Canada. They are currently undertaking an IPO on the ASX. Montem has 3 main projects currently, and to discuss this offering in detail, here is CEO Peter Doyle.
My name is Peter Doyle. I'm the Managing Director of Montem Resources Ltd. Montem is an Australian company operating in Canada with coking coal assets in the Crow's Nest Pass. Our assets are based in the Crow's Nest Pass in southwest Alberta. This is the heartbeat of coking coal production in Canada. Nearby, Teck Resources produces 25 million tonnes annually. Hancock has just purchased recently a very large project nearby called Grassy Mountain, and Attram Coal has some large development projects. We have three main projects. The first is the Tent Mountain Mine, which we're restarting, and we expect first coal in 2022. The second is the Chinook project, which has the potential for large-scale developments of open-cut coking coal. And the third being our exploration areas, such as Isola, where we've excitingly just found an exploration target of 900 million tonnes. Over the past 3 years, we've invested $25 million in our projects, bringing the Tent Mountain Mine through feasibility and ready for construction. Our strategy is simple. We intend to restart the Tent Mountain Mine and use that near-term cash flow to fund our larger development projects. By doing so, we minimise dilution to existing shareholders and get the company started far faster than larger greenfield developments. Canada is the third largest supplier of steelmaking coal to seaborne markets and very well supported by Asian buyers. Montem is attracted to Canada because of the availability of excellent, shallow, open-cut coking coal resources, access to export infrastructure, good diesel prices, good labour, and governments that are backing companies like ours to develop their resources. The Albertan government is very supportive of developing the steelmaking coal reserves of the Crow's Nest Pass. Our first development is the restart of the Tent Mountain Mine. This is an existing open-cut mine with the potential to produce 1.1 million tonnes for 14 years. We expect to get full operating licences in 2021 and restart production in 2022. The Chinook project and our other development projects have the potential to produce open-cut hard coking coal mines of the scale of those at Teck Resources in the Elk Valley and as big as Queensland's Bowen Basin mines. We're very excited about the Chinook project and our other development projects. Chinook is being studied as a multi-mine development over a long strike length, producing Tier 1 hard coking coal from shallow, low ratio open-cut mines. Beyond Chinook, the recently delineated 900 million tonne Isola project has tremendous opportunity for exploration and potential development. We have tremendous growth prospects over the next 5 years. Coking coal, or metallurgical coal, is a relatively rare resource and an essential ingredient into modern steelmaking. The outlook for steelmaking coal is robust. Accelerating infrastructure builds across the developing world drives steel demand and in turn steelmaking raw material demand. We're very excited to bring this opportunity to investors.
It's my pleasure to introduce our first panel session of the day, centered around funds management and deal making. Panelists include James Posnet, Senior Manager, Listings Business Development at ASX, Leld Smits, Co-founder and Executive Director at the Capital Network, Richard Ivers, Portfolio Manager, Prime Value Asset Management, and Monique Kotecha, CEO of InSync Funds Management.
Welcome to Wholesale Investors Small Cap Virtual Showcase, and get set for some expert insights with our industry panel. Joining us today is James Posnet, Senior Manager Listings Business Development at ASX, Richard Ivers, Portfolio Manager of the Prime Value Emerging Opportunities Fund, and Monique Kotecha, Chief Investment Officer at InSync Funds Management. First up, as we are at the Small Cap Virtual Showcase, it would be helpful to get an understanding of how the global pandemic this year has shaken up the small cap sector in Australia and where the opportunities are emerging. I may start with you here, James, coming from the ASX. What observations do you have over how this COVID-19 global pandemic has impacted small caps?
Thanks, Lola. It's quite a big question, so I'll try and keep it very brief for now. But ultimately, on the IPO side, which is where I predominantly sit, we've seen a decrease in IPOs. So we would ordinarily see about some 90 to 100 new listings a year. This year to date, we've seen 42. So it's a significant reduction in terms of IPOs, but the real sort of takeaway, I guess, at the moment is, given the buoyant markets, we are seeing IPOs come back, and so the pipeline looks good for the rest of the year. So we can expect sort of somewhere between sort of 30 and 40 new listings between now and Christmas, which is quite exciting. So at a sort of high level, that's what's happened, and lots of the listings on ASX are in that small cap space, as you may well know. On the another feature on the follow-on side, though, follow-ons have gone through the roof, for want of a better term. It's been an incredible year for follow-on offerings on ASX. We've had sort of $46 billion raised across the market as a whole. Now that's obviously small caps, large caps as well, across the board. But it's quite phenomenal. That is number 5 in the world by exchange. So out of sort of 90 or so exchanges in the world, we're number 5 on that basis. And in terms of number of deals, we've had 900 follow-on offerings in terms of number of deals, which puts us number 1 in the world by exchange. Which is quite phenomenal. And again, a number of those deals, yes, there are some large caps in terms of the value raised, but a number of those 900, the majority are small caps doing smaller deals. So that in a nutshell is what we've seen on the listing side.
Well, that's quite incredible growth, given the really this global pandemic and how it has negatively impacted so much of society. How about for yourself, Richard, from a portfolio manager's perspective? What changes have you noticed to the small cap sector this year?
Yeah, it's really upended our views on businesses, really. I mean, we've had to reassess every individual company in the market to determine sort of where they're at. There's been some big winners and some big losers. And, the winners are the obvious things like the tech and online retail, and the losers are obvious ones as well, things like, bricks and mortar retail and tourism. And with those losers, the balance sheets have come into sharp focus as well, because in some cases revenues have dropped to zero. And if they've got debt, it's obviously hard to service that, which is what James was talking about in terms of the capital raising. So it's absolutely caused a complete reassessment of businesses and business models, and it's evolving too, because we're still in the economy is not as bad as it was back in March and April, but we're still going through a difficult period. But then there's sort of some light at the end of the tunnel with the potential vaccine next year, where things could revert, and the losers this year could end up being the ones that rebound the best next year. So it's a real period of flux.
Okay, and Monique, what thoughts do you have, given the pandemic, on the small cap sector?
Yes, well, we run a global equity fund that's clearly more concentrated at the large end of town. Having said that, we obviously keenly observe what's happening at the small end, because a key focus for us is being future focused, and it's really about identifying global secular megatrends. So we have a keen interest, obviously, observing what are some of the emerging trends out there, and usually the smaller companies are at the vanguard at the initial stages of the trend, and it's only really later on that the larger companies then get a lot more involved when they see the trend developing, and they obviously have the balance sheet then to invest. So to specifically answer your question around small caps, I mean, I think one of the potential losers, unfortunately, I think longer term, or certainly as a result of COVID, has been the small caps, because the larger companies have had the stronger balance sheets. They have much greater access to capital. And so even where they had smaller competitors coming into the market and perhaps starting to cause some problems, because the balance sheet hasn't been as strong, a lot of their competition has disappeared and it's really reasserted their strength, the competitive strength of their industry. So obviously there are always opportunities in small caps, you can always find winners. But I think what's happened as a result of COVID is that it's really changed the dynamic, the competitive dynamic in favor of larger companies.
Absolutely. Now, you mentioned mega trends. I'm curious to hear which mega trends you think that small caps are well positioned to capture. Could you give us some examples?
Okay, well, where you typically find attractive opportunities in small caps, particularly today, it's not just only COVID. I mean, the demise of bricks and mortar has been in place for a number of years, as you know. So there's always opportunities there for a new company in retail or a related space to be able to come online and use the technology, use the digital technology to engage with their customers and grow very, very quickly. So I think there's always opportunities across almost any sector for small companies to emerge and do very, very well. And, a lot of them won't have the hindrance of having old legacy infrastructure and old ways of communicating with their customers and all the costs that are associated with that. So as a general comment, I think small companies can still do very, very well almost across any sector, provided, particularly in today's market, that they can come to the market at a much lower cost. They can do it much more quickly, and they can come up with products that can engage with customers a lot more quickly because of social media as well. That's actually brought down, the cost of branding and being able to getting your product and service into the marketplace. But specific to your question, some of the areas that, and again, we don't specifically invest in these areas, but we're keeping an eye on it. Areas that are emerging, obviously around fintech would be one good example, where there's a lot of smaller players that are emerging and really initially started to take the lead. So a good example in Australia would be PayPal. Not PayPal, would be Afterpay, right? And they really created a market very quickly and did very, very well. So I think fintech's certainly one. Another one's telemedicine and telehealth. And again, there's a lot of smaller players that have been around for a number of years, and we believe that trend's now starting to accelerate. So they would be two very interesting areas, I think, for small caps over the next sort of 12 to 24 months.
Okay, and Richard, from an investment perspective, mega trends, sectors, which ones are you focused on for the coming 6 to 12 months?
Yeah, it's things like online retail and technology are the ones that we also see as, the potential big winners. And they've really, what it's done is that it's accelerated their growth or the adoption rates of customers towards those sort of businesses or trends and brought it forward, a few years. Because there's still a question mark, and we're still assessing what the duration of that is, because we're going through such unusual periods now. I'm based in Melbourne, so I'm working from home, and I'm forced to work from home. When we're allowed to go back, it's still a level of uncertainty as to how people will behave when things revert, if it does, and we are successful in seeing a vaccine. But there's definitely been an acceleration, definitely a benefit. It's just the level of that benefit and the duration of that benefit is the question mark, which we're watching and assessing really closely.
Okay, and James, from an ASX perspective, have you noticed that this year there, in terms of sectors, there's been inbound interest from sectors that perhaps are aligned with these mega trends?
Yeah, absolutely. Yeah, in terms of the sort of new IPOs and those on the way, the buy now, pay later space has been very hot. And, there's a lot of sort of commentary in the market, of course, about that at the moment. Some people think that the penetration is still relatively low. It's about sort of 8% of online transactions is buy now, pay later at the moment in Australia, and about 1% transactions in the US. So there's potential upside there. But obviously a lot of players and, with PayPal entering that space and others entering that space, NAB has got a sort of interest-free credit card now, I think it was recently announced. There will be a lot of competition, but the pie is very large. So it will take time to play out, and it'll be quite an exciting area for some time. In terms of, just generally, we're on Zoom at the moment, and that's obviously travelled very well at the share price in the US in terms of number of users. So sort of online communications is something that's obviously here to stay. It was happening anyway, but COVID has sort of helped accelerate that. And I agree. Fintech, e-commerce, SaaS as a very broad category. And then really healthcare. I think COVID is sort of, obviously there's some more specific companies that are targeting COVID, but we've got others that I think it really has highlighted the healthcare sector is very interesting broadly. And so I think today on the panel we've got sort of 3 great recent listings in the healthcare space, and and that's been really, really good to see. And then the other trend I think is gold, of course. So gold mining companies taking advantage of the high gold price. That might be temporary, and then it's a very difficult one to predict, the gold price. But certainly it's high at the moment, and that's attracting more interest from them. So I think in terms of sectors broadly, that's what we've seen. And I think really the final one would be sort of data center. Like NextDC, for example, storage of data, that's going to be quite critical in future.
Well, it's great to hear the ASX is at the forefront of attracting companies to those with those mega trends aligned with them. I know I just spoke with neuroCare's CEO, and he's also presenting at Wholesale Investor in MedTech, and was saying how excited he is to be listing on ASX. But I want to come back to a comment you said, saying that for the buy now, pay later sector, that the pie is very large. And I'm curious to get Richard and Monique's view on that. And perhaps Richard, starting with yourself, do you think that there still is a big opportunity here to capture when it comes to the buy now, pay later firms? And would you even mention some companies that you like, or do you perhaps, on the other hand, think it's getting to some lofty highs?
Our style of investing is very much a low risk approach and protecting downside. And at the moment, for example, every company in the portfolio is making a profit. And these are great businesses and have done fantastic things and grown very strongly, but it just doesn't suit so much our risk profile of our investors. So we don't hold any of the buy now, pay laters. I know there's 7, I think, listed at the moment. Yes. Which is an incredible amount, and I don't think any of them are making a profit at the moment. And it is getting more competitive. But we do have a strong belief that in investing in the best of breed businesses. And so if you were to invest, if we were to invest in that buy now, pay later, would tend to be attracted to more like the Afterpays and the Zips. Which are the ones that have led the charge and have got scale and a presence in market. So they would be the ones that we would tend to focus on, but they're just not the businesses for us at the moment with our client base.
Sure. And Monique, what are your view on the buy now, pay later firms?
Well, again, clearly Afterpay were very early into that space, and then obviously benefited from that first mover advantage up to a point. But this is one of the key things when you're sort of investing in small caps and looking at early growth companies, is you've got to it's not only the size of the pie that's important, but it's also the barriers to entry and also the threat of competition as that market continues to grow and evolve, which is why we typically come in a little bit later. We love secular mega trends, but we like to invest in them when they're a bit more developed, and it's becoming a little bit clearer to us as to who the winners are going to be, because our view is that the market tends to undervalue and underappreciate both the durability and the profitability of companies that are benefiting from the mega trend. Once it's become a little bit more, as I said, it's developed a little bit more. Specifically to this area, with PayPal entering the market, and that is a stock that's one of our largest positions in our portfolio at the moment. I mean, they're benefiting from multiple mega trends they're having for a while. There's obviously the move towards the cashless society. As Richard mentioned, there's been an acceleration in e-commerce, and that trend was already very strong, growing well ahead of GDP prior to COVID. And what COVID has done is it's brought forward a lot of years of growth as more consumers are now have adopted the online experience and become very familiar and have accepted it as part of their life. So we believe that trend will continue for many, many more years. But with PayPal now entering that market, and they've got 350 million customers globally that they're working with, it is going to put considerable pressure on the existing players like Afterpay and others, simply because they can charge a much more attractive fee and still generate a very high return compared to the Afterpays.
Absolutely. And Richard, what do you think about these views yourself when it comes to your investments in the technology sector? I mean, Monique said there that there's significantly more growth in technology. One of my questions was going to be, do you think the growth in a technology small and mid cap will continue? It's clearly got some room to grow, but for how long do you think we're likely to see these gains in the tech sector?
Absolutely. I think the tech sector's got a long way to grow. I think, we can all see that with the way the world's changing and how our own behaviours are adopting to new technology with things like mobile phones, the smartphones. There are a number of very, very high quality business models within the tech sector, particularly businesses like software, which have, recurring revenues where if you think of, like we all use Excel, someone that everybody would understand, something like business like Microsoft, where you use Excel and Office, and you cannot literally not operate your business without that software. So it's incredibly embedded and useful in what we use, and the economic advantage of paying that small fee for that software is very low compared to the benefit that you get. So software particularly is an area we focus on and invest in, and these businesses are going to get stronger and be more and more useful. And one of the other interesting things that's happening at the moment with COVID is it's making a lot of businesses really focus on costs. So we've just come through reporting season. I've probably spoken to 100 companies in the last month, and just about every one of those is focused on cost. And in looking at costs, software and technology is often a way by which they can reduce costs and create productivity benefits. So I think that trend is going to just continue.
Okay, it's interesting you mentioned growth there, because obviously being a private or public company, they're all focused on growth. James, from your perspective, as you speak to companies that are considering listings and obviously speaking to listed companies, how are you speaking to them, or perhaps advising to them to navigate in this environment? What do you say when a company asks you, should I go public or should I stay private?
Yeah, there's obviously a lot of considerations there. I mean, this environment has caused some questioning in terms of IPOs, and hence we've seen a drop off in IPOs this year. But actually, most of it has been postponement of the IPO. So it's really, aside from the sort of company specific considerations, obviously market and timing is really important. So a lot of those sort of small cap IPOs are on the way now that were coming earlier in the year before. I think the main thing to think about is, why do you list versus not, conceptually? And I almost find myself going back to 101, why do you list versus not? And it's sort of three reasons really: capital, liquidity, and visibility. And so, with the world awash with private money, we've sort of almost had to go back to basics with some entrepreneurs, because they're obviously great at what they do, but they're not necessarily thinking, that's actually why you list. And it sounds quite basic, but actually from there you can then talk about the actual liquidity benefits in particular. So the ASX is a great market for follow-on offerings, for example, as we discussed earlier. But what that means is that you can raise money in 2 days versus going around and trying to do another private round. So that, for me, the number one thing about listing is the access to capital and the liquidity that you get from listing. Now, you do need to be well prepared though as a company, and so you can come too early. So that's what we're often discussing with companies: is the timing right? And quite often it's sort of two questions. Am I large enough to attract institutional investment? is that going to be interesting enough for institutions to participate in that IPO? And am I developed enough to handle the obligations of being listed? So the ongoing obligations of reporting and so on. And also, can I absorb the costs and time that it takes to be listed? Because it's a great thing to be listed, but actually, there are pros and cons. So going through that with the company in detail is obviously quite key. And what that often means is that you tend to wait a bit longer when times are a bit tougher. You'll tend to wait and actually look to raise more money. More is generally better, because you want to be as well capitalized as possible if you're hitting the markets during uncertain times. The market has been quite buoyant relatively. I mean it's still sort of 10% down on the year, but healthcare and tech is up on the year. So it's obviously a sort of two-speed market at the moment. But if you're in the healthcare and tech space, there is still opportunity to list. So the timing at the moment it is still okay, notwithstanding lots of external risks. So it's going through these considerations with companies. And quite often we're also having new discussions with companies about listing in future, like literally starting the conversation now, which you might sound a little bit unusual, but we are, so it's all layers, all stages of those discussions. And the general mood is it's still conceptually very attractive for companies, but obviously it then comes down to preparing well and getting the timing right.
Sure thing. It's interesting, earlier in your answer you said going back to basics, and I suppose from an investment perspective I'll ask Richard, you describe yourself as a growth at a reasonable price investor. When we look at the basis of your investment thesis, why is this your preferred approach to investment?
Yeah, sure. I guess we talk about GARP as, and it's really just a way to, I guess, pigeonhole some way or communicate the way we invest and our style more broadly. But what we really focus on is quality businesses that are growing, and we have a valuation overlay. And by quality, I mean we're looking at management and the sustainability of earnings. We also tend to focus on best of breed in the sector, as I highlighted earlier. With the belief that the best business models with the best customer offer tend to do better over time, particularly, as we've illustrated recently, that business models continually get tested. And so we believe that the stronger get stronger over time, and that is proven out to date with COVID. And then in terms of valuation, we really just think about what's a reasonable person would pay in terms of a multiple for a business. And then we forecast out a few years and look at what that valuation gets us, and then we can do an IRR and work out whether it fits within our 10 to 15% target return. And that's the way we sort of think about stocks more broadly. There's a lot more nuances than that, but that kind of gives you an idea of from a high level. Okay, and can you give me a quick example of a company you're currently invested in that you're a fan of and why? Sure, Melda. So an example would be, say, Ausbrokers is one that we hold at the moment. It's a mortgage broker, it's an insurance broker here in Australia. And insurance, as we all know, is a core requirement. So if you're going to run a business, you need to pay your insurance to continue operating. So it's a relatively non-cyclical business. It's very defensive. And what the insurance broker does, they don't take underwriting risk. So if there's a catastrophe, for example, they don't wear that risk, the underwriter does. So it's a relatively sustainable earning stream, very high cash flow generating, and is getting good growth. We've seen the business model generating sort of 10 to 15% growth over many years. I think I first invested in this business about 10 years ago. And it grows both through organic growth and through acquisition. So it tucks in other insurance brokers and buys them at attractive multiples. And there's a generational change going on with insurance brokers as well. So the older insurance brokers are looking to sell out. So there's fertile ground for acquisitions. Okay, thank you for that. Now, Monique, you are a chief investment officer, and we mentioned your ability to spot megatrends before also investing in disruptive companies. What's your secret to spotting potential unicorns, and where do you think the next one will be?
Right. Well, the core to what we do is investing in megatrends, and the beauty of megatrends is they generally have less sensitivity to GDP. So with COVID, for example, we had to make very few changes to our portfolio to what was obviously a very disruptive and dislocating moment in the economy and in the market. So that was the pleasing feature, because megatrends tend to be very enduring. They tend to be very long term, unstoppable, and very large markets at the end of the day. So as I said, one of the ways we seek to invest in a lot of companies is the fact that many investors sometimes look at the businesses that we own and say, look, they look a little bit overvalued on the short term, but what they're undervaluing is the sustainability, the durability, and the speed of growth that's actually taking place, and that doesn't get picked up in any sort of long-term valuation model. So the secret, there is no single secret in a sense. It's obviously some art, and a lot of data gathering, and looking for evidence to corroborate, a lot of the information we're thinking about when we're thinking about that particular megatrend, the size of the market, the speed with which it's growing. So we collate a lot of data, and we make sure that, it's consistent across the board. So we have a high degree of confidence in it. And it's only once we get to that point and we can find a really attractive business model that's clearly demonstrated high levels of profitability and good capital allocation. So they're reinvesting, and every time they reinvest into the business, the incremental return they're getting on every dollar is very, very high. So sometimes with early startups in the early phase of a mega trend, you see a lot of customer acquisitions taking place, but not a lot of profitability and cash flow growth. Whereas in our businesses, we see a lot of very high levels of profitability. We're starting to understand who the winners are going to be, and then we can get behind them and back them. Obviously monitoring valuation, but it's really the long-term valuation we're much more interested in. So that's really the art of sort of identifying these mega trends. And I think the other thing is, because we're so focused on it, it's a core part of what we do. We have a very experienced team doing that. We're doing it for multi-decades, each of us. It just means that you just get better and better at spotting them and working out which ones are at a stage where we can invest and which ones are perhaps we're a bit too early. We just need to keep an eye on a bit more.
Sure thing. Well, look, it's been great to speak about all of the opportunities that are currently present in the market, especially amid all the negative news that we're receiving and have received this year. I'm curious, perhaps as a final question as well, when we look forward, to hear what you're most excited about, in whether it comes to the small cap sector or mega trends. What excites you about the current future of investment or listed companies? Perhaps starting with yourself, James.
Yeah, look, I think what's most exciting to us on the listing side at ASX is the fact that we've got some great momentum in both technology and foreign listings on ASX. So the past 5 years, we've effectively doubled the peer group in tech listings. We're at about 270 now in that sector. We also launched the ASX S&P ASX All Technology Index in February this year, which was a bit of a tough time to launch an index, but I'm happy to say it's well above water for now, at least. And that's that just gives a little bit of I guess higher profile to those companies globally. It's got the S&P name attached to it as well. And in terms of the foreign listings, we're at about 250. So a number have been from New Zealand. We've got sort of 58 from New Zealand, and that's effectively doubled in the past 5 years as well. You can tell there's a theme here, but I think the momentum of this is going to continue on ASX. And the other thing that excites me is that, yes, we've had a good sort of run of tech listings. A lot of them have been in the small cap space, but a number have really matured. And so you've got to a point now where the sector is about 140 billion, which is roughly sort of 6% of the market. Now, 6% doesn't sound like a lot, and I'm really thinking from the perspective of there's plenty of upside. So it's actually come a long way, but there's plenty of upside to go. We continue to look around the world for opportunities, and the US is quite exciting as well. We found in the US market, it's kind of interesting. Certainly in the small cap space, you're really, when you're pitching an ASX listing, you're actually pitching against private markets in many cases. So a company could be running a Series C dual track, doing a Series C round, and then looking at ASX at the same time. And we've managed to attract a few interesting companies that were doing just that. So Limeade, for example, SaaS business from Seattle, came last year. And we've also attracted interesting companies like Fineos from Ireland, which is in the SaaS space, or insurance software space. And so those are interesting opportunities for the Australian market. And I think it really just validates more the homegrown technology companies that the ASX is a really good avenue for raising capital. Now, there is obviously the right time to raise capital, and we are quite sensitive as to when that is, as I touched on before. And, it really does vary. And I sort of hesitate to sort of say, anchor people to numbers. But when we think about the institutional investment interest, it comes, around that sort of raising 20 million on 100 million valuation, for example. And what does that mean? It means to revenue maybe of sort of 10 or 20 million. In the tech space, just generally. But again, it's hard to anchor to numbers, because actually, if you think back, Xero listed when it was a $50 million company, Afterpay listed with revenue of $250,000. So I want to just caveat those numbers as well. But what I'm really trying to say here is that, for small caps, ASX is a fantastic place to be. And it's also, related to index inclusion, of course. You can enter an index far earlier here than you can on other markets, say the NASDAQ market. So you're entering the sort of all ordinaries index at about 150 million market cap. The ASX 300 at about $300 million US market cap. And if I compare that with $11 billion US market cap to enter the S&P 500, what we find is that there's a real opportunity here, because many companies that would maybe in the old days have looked at a NASDAQ listing are looking either to private markets now, because you need to be a sort of $1 billion plus business to really get traction on NASDAQ these days. But, as you can imagine, there's a lot of companies below that level. And then it goes back to the old arguments, when do you list, when do you not list? And so the attractive thing is that listing still, even in this world of private capital being awash, is still attractive. So I think in terms of the future, I'm quite excited that interaction will continue to play out. And it's not necessarily, it's not to say we compete with private markets only. It's actually complementary, of course. So early private money goes into companies, and later there can be a liquidity option down the track in terms of IPO instead of late stage. So these things are going to be quite interesting going forward, and in short, I just think that momentum of tech and cross-border listings is quite exciting and will continue.
That certainly is very exciting. And Richard, from your perspective, what's exciting you about the future of small caps?
Yeah, I think I echo James's views about the small cap sector here in Australia. I think it's really matured. I've been in this market for about 17 years. It's really matured and got the quality and depth of businesses in the small cap market has improved significantly. And the other interesting thing that's happened is that a lot of Australian businesses have been successful going global. I remember 10 years ago, if you went global, it was seen as a risk and your PE would get derated. Now it's actually a positive, and a lot of businesses have been successful. And we've got a lot of quality small cap businesses that are really succeeding overseas. The likes of City Chic and Redbubble, two companies we hold. So that's an example, and echoing what James says. But what excites me too about now is that we're in this period of flux, and as a stock picker, that's what you want. You want periods where things are changing and evolving. We do an active company visitation program and have a lot of experience doing it. So in periods of change, it kind of plays into our strengths. inability to pick stocks and pick on new trends and businesses that are going well. So we're really excited about the outlook and how things are going to evolve over the next 12 to 24 months.
Fantastic. And finally, Monique, over to you. What's exciting you for the future of small caps?
Well, as I said, we focus on large caps, but I am actually really excited about the future. There is, so much innovation going on today. And, this is I think we've started the process, but this really is the decade of innovation. And I think what we're going to see within the ASX, for example, these are obviously my own personal views, is we're going to see an evolving structure from the old to the new. In the US, we've already seen that. There's obviously well-established, large capitalized technology companies that make up a large part of the benchmark. And I think we're going to see a similar thing in Australia where, a lot of the old businesses that were starting to be disrupted, well, what COVID has done is accelerated the disruption. And what we're seeing now is a rapid growth in new technologies, which is going to, I think, change our lives for the better and create a lot of wealth in the process. So we've already spoken about a lot of the spaces, but it's technology. It's, we're really excited about digital health, for example, because, what we now have is a collision of trends that is really going to drive the growth in digital health. So we've obviously got great success around gene sequencing. We've got machine learning, and then you combine that with the emergence of 5G. And what that basically means is that for a 60-year-old patient, for example, who was suffering from a history of heart failure, there was a poor understanding of his disease, there was very poor compliance, and the diet and medication wasn't appropriate. And we're now going to move into the digital space where that same person is going to get a personalized health plan that's really tailored for that individual's need, with all the education, the nutrition, all the maintenance of the medical records will be up to date. So when you go and see any specialists or doctors, that information is at hand immediately. There is no lag in time, so it can be very effective in terms of providing the right quality, advice. And, there's going to be a lot more proactivity and surveillance. And interestingly, the whole process is actually going to also lead to a reduction in healthcare costs. We know healthcare costs is one of the largest costs borne in almost any country, any developed country around the world. And, there could be a potential 60 to 70% decline, when you've got better surveillance. Basically, it just stops that individual from having to go to the hospital and the expense that comes along with that. So, very, very excited about innovative companies. These are real companies. They can gain profitability very quickly. This is not like it was 20 years ago. And so talk about the ASX, I'm actually really constructive. And I think as a small cap, if I was a small cap manager, I would be keeping an eye, perhaps more than I would have 20 years ago, these emerging companies, because if you don't, they're going to, as we've seen in the recent past, they grow very quickly and they become mid-caps. And before you know it, they'll become a large cap much more quickly than perhaps was possible 15, 20 years ago.
Absolutely. Well, James, Richard and Monique, thank you so much for your insights today. Certainly lots to be excited about for the future, and it's been great to have you all on the panel today.
Thank you.
Great, thank you.
Thank you.
Up next to present today is Lighthouse Digital, an end-to-end provider in the rapidly growing digital marketing, signage and advertising market. They boast a wide-ranging offering in the space, paired with a software for self-management, used at an international level. Here to talk further about this is CEO Jun Bei Liu.
Hello, my name's Jun Bei Liu. I'm the CEO of Lighthouse Digital Limited. We're in the process of raising between 250,000 and up to 1.5 million in a pre-listing offer for our business prior to listing on the unlisted securities exchange in New Zealand on October the 12th. Lighthouse Digital has both domestic and international business opportunities. In the New Zealand domestic market, we provide a complete end-to-end solution to our 450 clients, and we look at building long-term relationships with them. In the international market, one of our products that we have developed to support our digital signage business has international opportunities as software as a service. The company already has 450 corporate customers, an install base of 110 small networks, billboards and 20 large outdoor billboards. After the COVID-19 lockdown in New Zealand, we were EBITDA positive for the following 2 months, and we have developed $850,000 worth of back orders. Our products and services break into 4 segments. Digital billboards, we have 20 digital billboards located throughout the Auckland region. Media TV, which is a focused, bespoke solution providing services to individual market segments, such as the marina, garden centres, clubs. Our light sign software, which has been developed internally to manage the delivery of content onto those services of media, TV and digital billboards. And digital marketing, where we provide additional services to those clients who advertise on our media, TV or digital billboard product. We are a one-stop shop. We're unique in that position. There is no one else in New Zealand who is providing a complete end-to-end solution of billboards, digital marketing across the range of customer bases. We are very customer centric. The left-hand side graph with the circle shows the customer in the middle. We look at how we can offer them services and products that fulfill their full marketing needs. We have multiple channels to market. We have our own direct sales force. We work through third-party advertising agencies, and we also white label our product for third-party organisations who wish to go for large corporate customers. The market segment we're in is in 2 quite defined areas. One is the out-of-home market and the other is digital marketing. As you can see with the graph on the left-hand side, those are both very rapidly growing markets. The digital out-of-home market is growing on average 22% per annum, as currently 173 million. And the digital marketing business has now gone to over 1.5 billion in the New Zealand market and continues to grow. We have formed in February 2018, and since then we have progressively rolled out our own network, as well as acquired a number of smaller customer bases of competing networks to augment what we already had. This has meant that we have now got a significant customer base, as you can see below, with a significant number of ongoing relationships within those customers. The exciting product for us is our Light Signs product, which is a software as a service product. That product is the software that we use to run our own digital billboards and our media TV digital signage products. We have identified an international opportunity for that product, and we have been testing it in the New Zealand market and found it very acceptable. Of great importance is that the market for that particular product is about 4.48 billion in 2016 US dollars and growing to 9.24 billion in 2023. Our focus, though, is going to be on the Australian market. As a New Zealand company, we sell there at the market's about 60,000 units per annum. In the Australian market, it's about 300,000 units per annum. So we are very heavily targeting those markets. The company is set up as a public company should be. It's got governance of a board. We are preparing for the listing on the 12th of October, and therefore all the governance requirements have been put in place. We have an independent chairman and a non-executive director, and myself on the board. All of the people on the board have extensive public company experience and governance. The market capitalisation of the business post the transaction, if we assume we raise the full 1.5 million, will be about 7.7 million. And the investors, if they bring in the 1.5, will end up with 39% of the business, or if we raise 500,000, end up with 10% of the business. We welcome people to come and join us. The funds, we intend to use the funds to grow the Light Signs SaaS market. That's to go onto the international markets, to complete our listing for the USX, to further roll out our club TV, media TV and billboard networks, reduce debt to optimise the earnings, and then expand our sales force. As you can see from these projections, the left-hand side shows the actuals. The business is growing quite rapidly, and showing on the right-hand side is our forward projections, which we're on target to achieve. Importantly, operating cash flow goes up, and the projections of the business in closing cash and EBITDA is also positive. A valuation, we've undertaken a valuation of the business. That valuation came in at 74 cents a share post-transaction or post-capital raise, and it's based on a discounted cash flow model of 15% with a 1% growth rate. Our offer on this, for the shares in this offer, is 50 cents a share against the 74 cent valuation we've received. By way of comparatives, our EBITDA and EV comparatives are shown on the bottom right-hand side in comparative to other competing companies in the digital billboard market. This makes us, looking at these figures, it makes us a reasonably cost-effective investment. So the summary of the investment is we're going to raise $1.5 million. We wish to do that at 50 cents. The valuation of the business by an independent body has been 74 cents. It's a pre-listing offer. We are listing on October the 12th and it has been approved. It is an existing stable business with existing revenues, EBITDA positive, and it has domestic and international opportunities which we've identified and we're testing at the moment. Importantly, we're an existing business. We have clients, we have customers, we have cash flows, we have product, and we've sold them to over 450 new customers in New Zealand market, and that's growing at about 20 per month. Thank you very much for your time, and I welcome you aboard.
Our next presenter today is Global Health. Global Health is one of Australia's longest established and most experienced developers for software applications for the healthcare industry. They work closely with the healthcare industry, providers and communities when creating innovative solutions to support their clinical, business and operational needs. Here to talk further about his business is CEO Matthew Cherian.
Welcome, and thank you for taking the time to learn more about Global Health. My name is Matthew Cherian, Managing Director of Global Health. A little bit about myself while you absorb the disclaimer on your screen. My professional background is as an application software engineer involved in the business of healthcare since the early 80s. The company's involvement with the health sector goes back some 30 years to the early 90s when we developed and deployed applications for hospitals. In the early 2000s, we won a tender for the development of a mental health case management application for ACT Health. We recognized the need for connectivity across the many specialists involved and the need for patients to proactively manage their conditions. This is our core business now. Applications that connect clinicians and patients and empower patients to better manage their health and wellness. Our revenue is derived from recurring software subscriptions augmented with a variety of metered or pay-as-you-use functions. The market we service is potentially huge. Healthcare is a universal product. The management or treatment plan for diabetes, depression or hypertension tends to be the same, whether you live in Toorak, Toronto or Timbuktu. Expenditure on healthcare is spiraling out of control for a number of reasons. Better science leading to early diagnosis, more devices, more medications to help you manage your long-term illness from the initial diagnosis for the rest of your life. The number of people living with long-term conditions is also increasing rapidly. As living standards improve, our lives become more sedentary. We consume more food and drink and live more stressful lives from the demands of the modern digital age. The combination of these factors has resulted in healthcare expenditure increasing at a greater rate than GDP worldwide. In Australia, that's $500 million every single day. With 70% of these costs related to managing long-term or chronic illness, we need to find new ways of doing things and models of care so our healthcare system will not be overloaded and unsustainable. The COVID pandemic has highlighted the vulnerabilities of an overworked and costly healthcare system. Over the last 5 years, the company has invested heavily in innovation with a vision of a more patient-centric model of healthcare with consumers actively involved and empowered to manage their own health and wellness in collaboration with their health teams. Our connected health record is a portfolio of 4 SaaS platforms that are hosted in the cloud to work anytime, anywhere, and on any device. Referral and secure messaging is our core to the vision of connectivity. It connects the sector. Mastercare Plus has been designed to be super configurable so we can package affordable bundles to suit a variety of health delivery settings and combination of features. Lifeguard is for you and I as consumers so that we can be empowered and be the trusted custodian of all the information about our own health collected from our very many visits to a variety of specialists and augmented perhaps with data from remote monitoring and wearable devices. Odd Health is a patient relationship management system to help hospitals and clinics better manage their patient relationships and engage online with each other. Healthcare is one of the largest and most information-intensive industries. It affects every life on earth and every stage of your life on earth. from cradle to grave. Our focus is on the chronic disease sector of healthcare, which is the fastest growing and most expensive part of any healthcare system. Our new SaaS platforms have progressively been developed and released over the last 2 to 3 years. Prior to the pandemic, our expectation was a further 5 years before the market for our platforms took off, but COVID has changed that. We have experienced the momentum of demand for our CHR platforms to cope with an isolated world. Our vision and SaaS platforms are definitely what the market is looking for. I'd like to quickly go through a couple of our SaaS platforms, slides on our SaaS platforms. LifeCard is for you and I, our personal health record to record allergies, medications, management plans, health-related tasks on our phone. You can choose to share what you want to share, with whom you want to share, and for how long. LifeCard is for your family. Manage your kids' records, manage your elderly parents' records, or even your pets' records. Mastercare Plus has the potential, is for community health hospitals and clinics to support administrative and clinical users. ReferralNet is our connectivity platform embedded in all our software, making it easy for the sector to exchange clinical information between colleagues and between patients and their care teams. Hot Health has the potential to be our killer app. It is marketed as a digital doorway for healthcare delivery organizations and provides a wide range of engagement tools and features. One platform for multiple opportunities. We believe the breadth of our current portfolio and the fact we have over 1,000 hospitals and clinics gives us a definite advantage. These are some of the key existing customers using our existing applications to run key parts of their business. Our digital marketing campaigns are underway to upsell our connected health record platforms to these existing hospitals and clinics who are now looking for non-contact options to engage with their colleagues and streamline their patient's journey. We have spent the last 7 years steadily developing and refining our SaaS platforms. All our SaaS platforms have been funded through internally generated profits. We have not had a capital raising in order to develop this to the market. We have had a good financial year with all KPIs heading in the right direction. The COVID restrictions has meant that the postponement of projects from March has impacted our professional services revenue, which is down by 44%. But largely through existing expansion revenue from existing customers, our annualized recurring revenue, or ARR, has increased by a solid 26%, with recurring revenue now representing 70% of our customer revenue. Our EBITDA and bottom line have also shown solid gains. EBITDA improved by 180% to approximately 490,000, which represents an EBITDA margin of 8% on customer revenue. Largely due to the postponement of key projects from March, we reported a small bottom line loss of $660,000. This represents still a 95% improvement from the prior year. Subject to external conditions and normal business risks, we expect to continue the positive trend with growth in both customer revenue and earnings. Our goal is to continue our growth. In March, we set up a sales team in New South Wales to develop new logo opportunities north of the Murray, where we feel we are underrepresented. In the southern states of Victoria, WA and SA, our goal is to continue to expand our leadership in the community health market with more new logo sales. In parallel, our spend on digital marketing will target new customers for our CHR platforms and value-adding these platforms for existing base of customers. For my final slide, I'd like to introduce our board. We have an experienced board with a combination of legal, finance, capital markets, technology, and very senior roles in healthcare leadership across hospitals, community health, and government. We encourage a cautious yet innovative culture, committed to investments that will deliver long-term profitable growth, and the commitment to scalable, consumer-centric, and connected healthcare ecosystem. Thank you very much for your time and your interest. You can learn more about us through our websites, and we would welcome the opportunity to clarify or answer any questions you may have.
Our next presenter today is Memphasys, an Australian publicly listed company in the space of bioseparations. Memphasys is developing and commercializing innovative separation techniques based on their proprietary technology. Here to dive deeper into the specific applications and offering of this company is Executive Chairman Alison Coates.
Hello, my name is Alison Coots. I'm the Executive Chairman of Memphasys Limited, and it's my pleasure to talk to you today about what we're up to. As you see, we've got a device on the right-hand corner of this slide. I'll quickly go through the slides. First disclaimer slide, and now our value proposition. On the right is John Aitken, the co-developer of the technology, a well-established global figure in reproductive biology. And we have, together with him, developed this device. There are many interesting facets around the device. It's for improved IVF treatments, very, very large and growing global market for IVF. You use the device once it has a cartridge, and for every cycle you use a cartridge, and you can see how much the cycles are growing, that they represent cartridges. We're also partnered with Monash IVF, who are key in the field, and they've been helping us with developing the device as well. We are very close to commercial sales for early markets, and these early markets, they represent 24% of the global market. And we are positioned to make commercial sales in these early markets before the end of this calendar year. There's an opportunity also for developing the next generation device for use in animal artificial insemination and for other human applications. And we're fully funded to mid Q1 21. So the problem is about IVF itself. IVF fertility rates are in decline, and it's not just all about the female. In fact, the male generally has nearly half the time some impact, which is not well known. And there are about 2.2 cycles before people get success, but there is no guarantee of success. And IVF can increase the risk of miscarriage and a genetic impairment of the offspring, and there have been no meaningful advances in the way sperm has been prepared for treatments since the advent of IVF about 40 years ago. Current methods for processing and selecting the best sperm are laborious and lab-based. They're called swim-up and density gradient centrifuge. They cost between labour and materials $80 to $100 each time, and they take 30 minutes or more to complete. As I said, they're laborious, and they take a certain level of dexterity and expertise. And even worse, they can inadvertently select cells with DNA damage. Our device, which is shown on the right, is a very, very simple looking little device. It's got a lot of complex elements, particularly in the cartridge, but it's simply, you turn the button on after you've pipetted the solutions into the various components, as you see, A, B, and what have you in the cartridge, and it's a 6-minute process. We think that using this device should improve the likelihood of pregnancy, live birth, and having a healthy baby, and the process and various components are patented. It works. I won't go into great detail, but it's about electroforces. We use an anode and cathode with various media separating all of this, and the ejaculate is put into the first chamber. As you can see, all these funny looking cells, including white cells. We use a separation membrane to separate out the white cells and other debris, and the most negatively charged cells are attracted to the anode. That's the positive electrode, and it's a very, very quick, gentle and efficient. That's the basis of our separation. This is a before and after treatment. One of our people actually donated this, and you can see how very, very clean and neat it is. Our business model is to sell a console and the cartridge, a little bit like Nespresso. You get the machine, and then you get the pods, and you use the pods very, very regularly, and same for the cartridges. So the cartridges represent an ongoing single-use disposable consumable, and that's where the bulk of the revenue will be made. And so they are also used once per cycle, and it's that's where the margin is as well. There's a robust demand for IVF. I mentioned that, very, very rapidly growing. It's already a very, very large market. We've got key opinion leaders around the world, as you can see, testing the device. They're doing a in vitro testing between the way that they normally prepare sperm, whether it's swim up or DGC, and with our device. And whilst they've been caught, most of them have been caught with COVID, we're starting to get some results through, and results are very much what we would expect, and we're pretty happy. The pathway to market is that we expect commercial sales to occur. We're not expecting massive to begin with, because it'll be a very, very gentle and cautious approach, as it should be. But the early markets where there's low reg, virtually no real reg hurdles, are Japan, India, Canada, and New Zealand. And they're the initial countries that we're focusing on, although we've got a lot of other countries that we will also sell to, but there's a higher regulatory burden. The corporate snapshot is our MEM, the code is MEM. Share price as of yesterday was 12.5 cents. Sorry, that was yesterday being Tuesday, Wednesday. Shares on issue, you can read, it's nearly 100 million market cap. Top 3 shareholders, Bob Peters, a very, very notable investor in Perth. He's got 27%. Andrew Goodall, who's on the board with me and has been staunch supporters, 22, and I'm third at 10.6. You can read about the various directors and their backgrounds here on this slide. The investment highlights, just to recap, it's a novel sperm selection technology for improved IVF treatments. It's a potential to counteract male infertility and disrupt the IVF industry. And as I said, the males generally account for 50% of the infertile problem. There's an international commercial rollout from late Q4 20, and we're addressing a significant and growing global market. The devices are in hands of the major IVF clinics, KOLs. Initial feedback has been positive, and we're collaborating with major industry partners, Monash IVF and the global fertility expert professional John Aitken. And as I said, there's also ongoing development of a next generation device for use in animals and expanded human applications. I'd like to thank you for listening and looking at my presentation, and urge you to also look at the website. Thank you very much.
Our next presenting company today is PayGroup. PayGroup have the mission to provide multinational and workforce management companies a single view of their workforce whilst meeting regulatory requirements across the Asia-Pacific region. Here to talk further about this business is Chief Commercial Officer Sachin Goklani.
Hi, my name is Sachin Goklani. I'm the Chief Commercial Officer of PayGroup, and it's my pleasure to introduce PayGroup to you today. Who is PayGroup? It's a leading provider of global human capital management and payroll software and services, along with payments. So what does that actually mean? Well, for every employee who is a full-time employee, a part-time employee, or a contractor working, PayGroup provides the payroll, the core lodgements and payments, as well as the strategic human capital management modules like leave, expense management, time and attendance, rostering, and so forth. And we do that for over 915 clients, predominantly multinationals, across 33 countries with all the complexities, fully compliant, using 226 internal employees and a great partnership program across our 12 offices. What is the global payroll human capital management space mean? Well, Gartner, who we are very proud to be a multi-country payroll partner within their guides, says that the market for payroll and HCM globally is 26.2 billion, and the human capital management aspect of it is 2 billion. So PayGroup is in that space, in the niche of Asia Pacific and Middle East, assisting those customers, as I mentioned earlier. We are governed by a great board, which has the domain expertise and the great compliance to ensure that our core of payroll and our delivery of making sure that our clients and our clients' employees remain compliant in all of our 33 jurisdictions are kept whole. Along with that, our domain expertise along the likes of Ian Basser, who ran Chandler McLeod, Franck Naron-Bancel, who was a senior executive at the world's biggest company in payroll, which is ADP, and Mark Samlal, we have over 30 to 40 years of actual experience coming into PayGroup within the domain. And David Fagan, who was a 30-year veteran at Clayton Utz and the managing partner, helps us round off that compliance. Our customer base is predominantly multinationals, as I mentioned earlier, and our core is that we sign multi-year contracts with high retention rates, and we sign them at a regional level. So as we sign contracts within the regional hubs of either Sydney or Melbourne, or in Singapore, or in Hong Kong, or in Kuala Lumpur, or in India, we grow with our customer base. So we have 915 clients, 3-year repetitive revenue contracts at a minimum with automated renewals. We have a 95% retention rate, and very proud to have this set of clients on board. And we grow with our clients to not only expand geographies, but also to layer upon new services and products to the existing base. What's our journey been? So we started off in the core of payments and payroll, which is doing the payroll calculations and ensuring that we were able to lodge people's superannuation, lodge the company's taxation on a weekly, fortnightly, monthly basis on time and accurately. Over the time, we have invested in core or strategic HCM to link to payroll. And our journey has taken us from bringing on board the leave modules, expense management modules, and then in recent times with acquisitions, we've brought on board time and attendance, rostering, learning and development, performance management, and we've also expanded the addressable market, which is not just for full-time and part-time employees of corporates, but also to contractors in the workforce management space, where Astute Limited is a leading player in Australia. What is our suite of services and modules look like? As I mentioned earlier, the core payroll and HCM is all about doing the payroll, and it brings in the feeders to payroll, which is your timesheeting, your leave, and your claims. And we offer that in a single view, delivering your pay slips and delivering the reporting to those HR directors and CFOs who want to know whether all their people are paid on time and whether their company is kept compliant through the lodgements. We also have added the strategic HCM modules, which now bring about the layer of extra, modules and revenue on top for us when we offer onboarding, we offer recruitment, we offer time and attendance, talent management. And through that journey, we've also invested heavily in AI and business intelligence and created some very clever reporting modules, as well as our new chatbot, which we call Tozy. And all that is wrapped around our great treasury services, which looks after making sure our clients' employees are paid on time, that their superannuation funds are paid on time globally, and that we pay their personal tax as part of their HR delivery. Just a bit of growth scorecard on how PayGroup has actually progressed since its listing in May 2018. We measure ourselves on our annual recurring revenue, and that is driven by the number of pay slips and transactions we process on a weekly, fortnightly, or monthly basis. So PayGroup has had a great trajectory since listing, where we had 630,000 pay slips per annum in FY19, and we are a 31 March balancer, to today, where we are over 5 million pay slips per annum. That has made our ARR, our annual recurring revenue, grow exponentially over that time, and the next release will be in November when we release our half-yearly results. On that same journey, we've onboarded more internal employees, mainly through acquisitions. And our sales trajectory has been exponential year on year, where we've gone from a 4.9 million base of total contract value sold in FY19 to 5.5 million in FY20. And just in the first 4 months of our FY21, we've already sold greater than $4.5 million of total contract value, which is already 82% of the entire last year's fiscal sales. So it's been a great effort, even in the COVID times. And one of the final great metrics for us has been how we're tracking on our operating cash position. And we're pleased to say that the guidance we provided to the market in the half two of FY20 of being statutory operating net cash flow positive has kept its way through, and we expect to increase that every quarter going forward. What's our outlook for this year and what excites us is all about our growth. The tailwinds we have right now shows that we've sold more than 82% of the whole of last year's sales in the first 4 months of this year. We're going to expand our partnership program, which brings all the sales feeds into us, along with our organic growth of having direct sales. We're going to expand our treasury services, which is our fastest growing division, to make sure we add not just the payments of salaries and statutory, but we bring in financial well-being and client monetization products to assist that revenue line at a high margin. And our focus remains on making sure that we increase our payslip delivery, we increase our treasury transactions, and we generate more and more annual recurring revenue by maintaining the same cost base to increase our margins. And of course, not losing focus on the cost efficiencies, of which we have identified 1.5 million for FY21 fiscal year. And I'm pleased to say that 5 months in, we've already achieved and implemented 65% of that. What are our growth opportunities? Well, we'll continue to focus on the core of payroll. We will continue to move towards the SaaS and digitization. We will continue to invest in acquisitions and partnerships to grow our customer base and grow our payslips and transaction base. And of course, we will focus on our core, which is delivering the payroll through services, payroll through SaaS, strategic human capital management modules through SaaS, and to underpin it all with our continued investment in business intelligence, AI, reporting, treasury, and client monetization to just build layer upon layer of revenue and to increase our margin. So I thank you for your attendance, and I look forward to discussing more about PayGroup during the conference. Thank you.
Up next is Optiscan, a pioneer in the development and application of endomicroscopic imaging technology. Their technology is used for both cancer screening and tumor margin detection in cancer surgery. Here to speak about this further is Executive Chairman Darren Lurie.
Good afternoon, everyone. My name is Darren Lurie, and I am the CEO and Executive Chairman of Optiscan Imaging. Optiscan is a Melbourne-based developer of a handheld confocal endomicroscope that enables real-time virtual biopsy images for human cancer screening and surgical margin detection. Our shares are listed on the ASX, and we have a board of 3, comprising myself and 2 of our major shareholders. Our team has successfully miniaturized a traditional desktop confocal microscope into a handheld probe with a diameter of less than 5 millimeters. Our technology is world-leading and patent protected. It enables real-time virtual biopsy-like images at a subcellular level with approximately 1,000 times magnification. It enables reduced and more targeted biopsies for cancer screening, and in surgery is focused on capturing all the cancer cells and reducing the amount of healthy tissue that a surgeon is required to take. We have both a laboratory product, which you can see on the left-hand side, and our InVivage clinical system is on the right-hand side. On the right-hand side, you can see our probe, which has a tip of less than 5 millimeters in diameter. And in order to capture images for both devices, you touch the tip of the probe against the tissue of interest. In this presentation, I'll talk to both the clinical and preclinical applications for our devices. In the clinical space, we are targeting both oral and breast cancer with our InVivage device, and we are also working on brain cancer as part of our cooperation with Carl Zeiss Meditech, one of Europe's leading medical device companies. Our 5.2 View in Vivo, our preclinical device, is focused on laboratory and translational experiments. And typical customers are medical research facilities and universities. There are approximately 350,000 oral cancer cases worldwide each year, and almost 180,000 deaths. But the application for our InVivage device is much greater, as almost 5% of the world's population will at some point develop an oral lesion. And while only 2 to 3% of these cases will become cancerous, diagnosis is currently very difficult without a scalpel biopsy. Our device is intended to provide a non-invasive way of reducing and making far more targeted biopsies required. The importance of early diagnosis is highlighted in the bottom half of this slide, where we can see the significant decline in survival rate and higher financial costs for both patient and hospital in the case of late diagnosis. The market for oral cancer is significant and highlighted by two of the major markets on this slide. In China, there are almost 50 specialist public dental hospitals and over 150 stomatology or oral medicine departments in general hospitals. In the United States, there are 900 specialist cancer centres and approximately 9,000 oral and maxillofacial surgeons. We have a number of studies underway in oral cancer. Earlier this year, we received almost $1 million of federal government funding for our 150 patient oral cancer screening study at the Melbourne Dental School. We have an ongoing study at the Memorial Sloan Kettering Cancer Centre in New York, one of the top 2 or 3 cancer centres in the United States. And we have an ongoing study with one of Australia's leading dental researchers in Perth. We are working on seeking FDA approval for our device in this oral cancer application, and in January of this year met with the FDA. We have sought further feedback from the FDA since this meeting regarding our regulatory pathway and expect to receive further feedback from the FDA by the end of this month. The second application with our InVivage device is in breast cancer. And unfortunately, nearly all of us know someone that has been touched by breast cancer. 60% of breast cancer cases are lumpectomies. And unfortunately, 20 to 30% of cases require a repeat surgery as not all the cancer was able to be removed. Having completed the imaging for stages 1 and 2 of our study at Western Australia's largest private hospital, we have discussions underway with a leading Melbourne breast surgeon and hospital about bringing this study to Melbourne in order to assess the excised tumour during the course of the surgery to reduce the requirement for repeat surgeries. The third clinical application which we're pursuing is as part of our cooperation with Carl Zeiss Meditech in brain cancer. Optiscan's technology, which is incorporated in our Invivage and 5.2 device, is also incorporated in the Carl Zeiss Convivo device. This device has 510K clearance in the United States and has also obtained approval in Europe. It has also been described by one of the leading neurosurgical institutes in the United States as the most exciting technology that they have seen. For our 5.2 View in Vivo laboratory product, over the last 12 months, we've made significant changes to our distribution model, and we're very pleased with the results, having achieved 3 sales in China since late 2019. We have a very exciting upcoming period. We will have commencement of our 150 patient oral cancer study at the Melbourne Dental School. We expect to commence the next stage of our breast cancer study at one or more leading Melbourne hospitals. We've increased the geographical footprint to deliver additional 5.2 sales in the laboratory market, and we're awaiting further FDA feedback on the regulatory pathway for our Invivage device in oral cancer later this month. Thank you very much for your time today.
I would like to introduce our second keynote speaker today, Jun Bei Liu, Portfolio Manager for the Tribeca Alpha Plus Fund. She will be presenting her insights surrounding sectors displaying growth potential over the next 6 to 12 months, as well as the key to analyzing market risk.
Hello, I'm Kylie Merritt. Welcome to the ASX Small Cap Virtual Showcase. I'm here with Keynote Speaker Jun Bei Liu from Tribeca. Jun, great to have you with us. Tell us a little bit about yourself and of course about the fund.
Of course. Well, thank you so much for inviting me. It's such a pleasure to always be here. Now, my name is Jun Bei Liu. I'm the lead portfolio manager at Tribeca Investment Partners. My fund is called the Tribeca Alpha Plus. It's been running for over 14 years and currently managed just over $750 million. It's a long-short fund, so it's very active. We chase after where the return is. Now, in terms of myself, I actually came to Australia when I was 16. Originally from China, so do excuse me that if I make any grammatical errors. But look, we're passionate at Tribeca, we're passionate about investing. I myself has been investing for over 18 years and across Australian equities, Asian equities for some time. I spent time too, and of course we regularly travel around the world to talk to the companies, talk to the competitors and the regulators. Not this year, it's a little bit difficult, but we do a lot of Zoom, as many people would do. So so that's us.
Okay, I want to delve a lot deeper into your strategy. You said you're long short. I want to look at all those opportunities, etc. But I do just want to get, take a step backwards and just get your view on markets at the moment. We've seen, the biggest disruption to global economies probably that any of us have lived through. And yet global markets seem to not just be looking through some of that, but looking well beyond, and many say kind of, into bubble territory. What do you make of what's going on?
That's a really good question. Look, I think there are lots of angles to and perspective you can take in the current market, but what's really is that at the moment there's so much opportunity, investment opportunity we can see. Look, there are certain sectors that have performed very well, they become very expensive. That's probably where a lot of spectators are talking about the bubble territory. But do remember, their valuation's gone higher is because money is very cheap around the world. And hence why all asset prices will be rising, because there's more money chasing after very rare growth opportunities. So they should be higher. Now, on the other side, where the company's earnings being impacted significantly by the lockdown and which caused by pandemic, of course they're going to look expensive. A lot of the company's earnings have collapsed. Look at the travel, look at airline, look at the shopping centers, gaming floors. These businesses, in my view, will experience, some of these, the premium ones, will experience a V-shaped recovery once we move truly beyond the lockdown and the virus impact. And some of those businesses, such as Sydney Airport, the premium airport assets, the premium private hospital assets such as Ramsay, there's an incredible amount of opportunity, once in a decade buying opportunity still exists in those sectors.
And what about the timing of that? Because you can imagine that the valuations at the moment are taking into account that yes, travel will recover, yes, private hospital operations will recover, but nobody really knows when, and nobody knows how quickly.
Absolutely. Look, the easiest thing for investors to do is to take a longer term view, because short-term sentiment can move and swing with the moods of the investors globally. And this is what represents opportunity for the equity markets, because it's liquid and it creates buying opportunities. Take a 6-12 month view and those assets. Let's take a private hospital, for example. The volume will return, because the minute we saw the lockdown was lifted, aside from Victoria, every other state, we saw that the volume picked up significantly in the private hospital, and it's already pre-COVID level numbers and above. And now, of course, the Victoria lockdown might take a little bit longer, but we know it should take the same shape of recovery as other states. And we're already hearing the backlog is about 18 months to clear. So on all these bases, share price will come back when the earning returns. And your opportunities currently, because many investors can't take the short term or can't take the long term view, hence why the share price is where it is right now. Shopping centers is the same thing. We're seeing recovery when things improve in different states, and then take a longer term view in 12 months, we should see that people returning to the shops. If you're anything like me, I'm dying to get out, dying to travel. But look, travel is slightly different. It's a little bit far away. But buying an asset like Sydney Airport, downside is very limited.
Yeah. So what about your strategy? You are a long-short fund, very active. Has it had to change during this sort of COVID period, during the last 6 months, or is it just the same as it's always been, just with more opportunities at both ends?
I think it's same as it's always been, a lot of opportunities. I actually find this it's during times of extreme volatility that strategy like mine actually shows its benefits, because we are seeing so many opportunities. But like you said, near-term earning might not be there, and they will go up 10%, go down 20%. So how do you manage that risk? So with the ability to short, I can go after every opportunity I see, let it be in the buy now, pay later sector, or whether it's in the casino space. I can buy them because I can short other things to offset the volatility of my portfolio. Hence why we managed to deliver the return through this cycle on the up month and on the down month, because we can go after the opportunity and ultimately they will deliver the return. It's the company itself that will generate the earnings and better expectations from investors.
Okay. So in terms of, sectors where you're looking for growth, you've mentioned health, you've mentioned travel, buy now, pay later. Anywhere else that you're sort of seeing some gems? Is it to you a sectoral thing, or is it very much a company?
Yeah, so for us is we're trying to find opportunities in almost every sector because they exist. And especially when you go into the smaller end, where opportunity is incredible. You look at the returns of the smaller index compared to the large cap, they're phenomenal because they exist all the growth opportunities. Take healthcare, for example. We like healthcare, it's defensive and the like. But you know what? large healthcare doesn't generate that much of growth at this point. Ramsay is a reopening play, but we found the smaller healthcare, such as Aroa. It's a tiny little business that just listed. It's very similar to Polynovel, but it's trading half of its valuation. And it's offering incredible amounts of growth over the next 5 years. So, it's story like that will generate the extra return, while at the same time you manage the risk of the portfolio. But you shouldn't be shy away taking opportunity of those exciting return opportunities.
So aside from obviously investing with you or watching AusBiz, how do investors, get on board? How do they find these stories? How do they find these companies, particularly at the smaller end? They're not generally covered extensively. How do you know where to start looking?
Look, to get started,
it's a full-time job, right?
Yeah, that's right. It is a full-time job. Look, for many retail investors, they got ideas from reading the financial reviews and the business sections of the newspaper. It does help you to build a broad knowledge of what is happening globally and what is happening on the company front. And companies such as Aroa, for example, they were talked about in the AFR before they came listing, and a lot of that. So you will see more airtime given to those smaller businesses, just given how well they performed. Share price doubled on listing. So, it's just all of that general knowledge of what's happening in the financial space, and then stick to the company You need to do research and stick to the ones you know.
You mentioned hot stocks and not to chase hot stocks. Buy now, pay later. What is going on in this sector? They're not just individual stocks that we're seeing this growth. Some of these numbers are just crazy. We have started to see, I think, some stuff's been topping out. We're starting to see some analyst downgrades, but we've seen that in the past, and they've just kept on moving higher. What is your take on this sector? Are you in? Are you out? Are you long? Are you short? What do investors need to understand?
Look, talk about hot stock. This is a very hot space. We have been believers of buy now, pay later, or Afterpay, really, investors of Afterpay for a few years now. What we really saw was with Afterpay is that they clearly demonstrated the needs and the niche that they found themselves in. The merchants that use Afterpay loves it because it changes conversion. So people will pay you and spend and buy things. And the customer likes it because it's convenient, and then push out when they pay out things. And then they can use on a high frequency basis. And it's not a credit product. It's not, you have to borrow from credit cards. It's different. And it's much more suited to the lifestyle of the millennials. Very skewed to the online shopping because that's where it's first born. And over the last few years, Afterpay has really demonstrated its ability of growing and replicate that model in US, and UK now start seeing early indication, and we can confidently see other similar markets should have similar sort of take up. In the US, growth has been phenomenal. We've seen how many times analysts upgraded those numbers just because there's a need and demand for a product like Afterpay. Now, of course, the share price has gone through the roof, and it has flow-on impact on the rest of the sector, such as Zip and then Sezzle and a whole lot of other areas. Our view has always been stick to the top couple players. We like Zip, we like Afterpay. Zip is slightly different, but it's a baby Afterpay that's coming through, and much broader product suite. But look, the future is enormous. They only just penetrated 1% of the US market, and now they're launching in Europe and Canada and UK. Each market could double what Australian market what they have done in the Australian market. So it's real, and we already seeing huge amount of institutional interest in this space. We saw the Silicon Valley private equity bought into Zip. We saw Tencent, which is a large tech giant out of Asia, took stake in Afterpay, and so this area is hot, and it has taken the spotlight from some of those tech names around the world. So it's a real space, but of course competition is heating up. So you're currently seeing a bit of share price coming back because PayPal has launched a similar sort of product. So as many other similar credit providers providing similar sort of space. So there is competition, but our view is that number one, top couple players, they will do well consistently. Just watch those subscriber numbers.
It is though something like a PayPal. There's Afterpay and there's so many others kind of in that space. But then you do get a behemoth, like PayPal with that brand. already kind of everywhere come in and say, actually, no, we're going to do this now. Is that a real risk, or is there, I guess, will the pie continue to grow so that it's so big that there's plenty of room for everybody to be profitable?
Look, I actually think this reminds me so much of the banking sector, for example. Banking sectors, banks are everywhere. They're offering every financial product services. At the early stage of the fintech rise of fintech in Australia, we're always fearful. What if the bank decide to go this area and your entire business model will fall apart? But the banks just can't concentrate because they have so many of their problems and so much of the old the traditional revenue at stake for them to focus on, than to focus on some of those areas where it doesn't make any difference to their overall earnings. So traditional asset owners or the PayPals and the like, which has been a bit behind in this payment space, generally, the historical experience has been that they tend not to be able to catch up as much of the flow just because the market leaders are already there, grabbed the land, grabbed the space, and represented their brand. Afterpay is now running Afterpay Day, and that's power. And Afterpay Day has generated significant amount of sales for its retailers. So it's all about the value you deliver back to the retailers. And if you can consistently doing that, then you justify your existence in the ecosystem.
Okay. You've talked about how you're sort of quite comfortable, I guess, with where the markets are at the moment, these sort of record high levels, despite what we're seeing, in the global economy. What are what would change your mind, I guess? What would make you a little more cautious or a little more nervous? What sort of indicators and stats data that may start to come out? I mean, we get data all the time. Payrolls, unemployment numbers, all of these are absolutely woeful, and yet the markets still keep going higher. What would it take for you to think, actually, there's going to be a fundamental shift here, and perhaps that weight of money won't be enough to keep markets where they are?
Look, the reason market continue to go higher is with the expectations things will get better, and because we have seen the early indications of how things are getting better, and the amount of money, cheap money that's around the world inflating that asset prices. Now, what's going to change that is, one thing is it could be that vaccine could be a long time away, we won't have any positive data out of those vaccines. And at the same time, the second wave has become far worse than expected. That would definitely dent the confidence of the equity market of what it might look like. However, that at this point, we're putting as a sort of more extreme example, more bearish sort of assumption. The normal base case assumption is really, look, vaccine announcement will probably come later this year. Whether they'll be available probably will take 6 months, 12 months. But that's the expectation. And also we just on the path to recovery, which we have seen, things will get better gradually. Not a sharp recovery, but it will slowly get better. But remember, what that means is that we will finally end the earnings recession, because we have had earnings downgrade for so long. Every year you just see analysts downgrading earnings expectations and outlook. But from here on, thanks to all the significant earnings cuts, earnings will actually grow from here on, off a lower base. So over the next 2 years, you will actually see earnings being upgraded for a lot of those sectors. And what that means is that share price will follow higher for those sectors. Clearly, it will be changing leadership. What sector will outperform, but you will see the market grind higher.
You mentioned Ramsay, for an example, a big, very well-known Australian company in the healthcare space. What other kind of, I guess, subsectors in healthcare or company specifics? I don't want you to have to share any of your secrets, but what are you really looking at in that space at the moment? What excites you?
Look, I think healthcare sector normally is, when you think about it, it's not an exciting sector, but it's been a growth sector and it's been a quality sector. So it's been extremely defensive during the sell-off, and even in the normal years, it's been delivering good growth compared to the banks and the others. So very defensive, very good sector. Now, what we're seeing at the moment is that there's a value end, which is actually the Ramsay Healthcare. It's a cheap value end, and it offers good earnings uplift over the next 2 years when things ramp up. So that's a really good space. CSL actually is looking big being the largest stock in the market, it is actually looking a little bit softer in terms of outlook, just because of disruption from plasma collection and the like. But what get we also excited is when you're going down the smaller end, Aroa is this little biotech that get us a little bit excited. Small position for us, but it will deliver really good growth, and it's very cheap compared to the likes of Polynovo and other biotech that's listed.
Jun Bei, final question. 2, 3, 5 years from now, put yourself there and look back for me. Obviously, we still don't know what's to come, but fingers crossed it can't be any worse or more crazy than what we've seen in the last 12 months. What do you think will be some of the big lessons that we've learned in terms of markets when you look back?
I think the big lessons that we would be by then kicking ourselves for not buying more stuff, because when we talk to some of those premium assets, the Transurban, the Ramsey or Sydney Airports, Centre Group, this is the once in a lifetime decade buying opportunity. March was great, but there was too much fear and everything around. But now still looks very reasonable, and these are the assets non-replaceable, a lot of those assets. So that's one thing we'll look back and thinking, well, should have bought those assets. And I think another thing going, by the time we get there, we will be looking at some of the, things that's currently happening in the background, but the equity market chooses to overlook. Things like the political tension, geopolitical tension that's happening, Australia, China, US, and around the world. Now, it is our view that eventually we will have this sort of decoupling taking place. Perhaps 10 years, perhaps 20. We don't know how long it will take, but gradually it will take place, just because to rising power and globally, and there will be a bit of tension. Now it's an opportunity in terms of investment. Now, which company will play to that? Because it's not all fear. And when you think about it, when you have decoupling, you have two sets of technology platform, you have two sets of everything, which is great. And but how do we take advantage of it? And I'm sure there are traps and things that we need to avoid, and by then hopefully it will be clearer, which sector might perform, and or even new sectors that might rise from this event.
Great, Jun Bei, thank you.
Thank you very much.
Great to talk.
Up next is CV Check, a business that has developed the most efficient and intelligent way to verify information ranging from police checks, hiring of overseas candidates, and many other forms of background checks. Here to talk further about this investment opportunity is CEO Rod Sherwood.
Hi, my name is Rod Sherwood. I'm the CEO of CV Check, and we're here today to present our showcase to the ASX. The deck that I've just prepared is from our annual results presentation, so we'll just dive straight in. CV Check is a people screening and verification business. So companies come to us to get a clear picture about their candidate. The type of information they're looking for is to confirm the identity of the person, check some details about the person's credentials and professional memberships, the capabilities that they have, the past job roles that they have. Examine their integrity. So we look at criminal history, bankruptcy, credit history, and so on. And then get some insights as to their work history and make some assessments about their fit to culture for that company. So we've been doing that for some time, and we're just going to present some of the details about the company there. Our go-to-market is twofold. The first is, and this is how we launched the company, we go direct to end customers, and they may range from individuals to SME businesses, large enterprise. And we have direct B2B engagement and marketing teams that do that. That has driven us to a large part of our business share that we have now. And then more recently, we also coupled that with a new channel, which is these integrations with other technology partners. And with those, we integrate into the back end of cloud-based systems. They are the like of SAP, Workday, PageUp People. And those entities can pull CV Check down out of the cloud as a microservice in screening and verification of people. So we have that more recently, started that in 2018. We'll come on to that shortly. The net result of that is that we are now a B2B driven business with high ARR, and we've got quite high revenue quality. How do we bring all that to the end customer? CV Check, our individual customer and our business customers are all together in a privacy triangle where we can exchange information securely. We pull in from the left-hand side of this screen secure data systems, infrastructure for our technology and so on from other places, and we've cut all that code for that. Then on the right-hand side, we have other means that people can order from us. But overall, we join up these business and candidates with verifiable data that we have through our supply chain. Been investing in that technology for a good many years. On average, it's about $1.5 million spend, but it's highly current. The issue is the customer doesn't care. They want to see that it all works. So we focus on that primarily, the customer interface. We have a large blue chip client base, very diverse. Some of the names that you see here are representative of that customer base, but it's important to note that no single customer is more than 2% of our revenues. Recently, we published our annual results, so this gives some idea of how our idea was translating to revenue and customer uptake. Revenue last year was 12.4 million despite COVID. We have around 10 million of ARR, so this is booked revenue, historically looking, from returning customers that have come through the business to 30th of June last year. Margins expanded to 55%. We had low cash burn, primarily in the quarter as we prepared for COVID shutdowns, and we ended the year with a very strong cash balance. Our revenue growth, you can see here, we focus now much more on B2B revenues. It's been sustained since 2017, and you can see that's underpinned also our recurring revenue growth. So we're quite happy with that. Took a little bit of a slowdown at the end of the year with COVID. That's translated to, this focus on B2B has translated to a significant decrease in cash burn, and the company is now, as you can see there on the right, a much more sustainable business. We've positioned ourselves to have modest cash burn and underpin what is now growth, a company positioned for growth. We also have, in that second go-to-market that I was talking about with the integrations with other HR platforms, we have a high growth arena here. We initiated this in FY18, pre-commercialised it, and we set about commercialising it from FY19. And you can see there that that's doubled, and that trajectory is continuing this year. The key issue to monitor here, and the metric that we look at, is each single one of these other HR technology platforms that we integrate onto our CV Check platform enables a new group and customer cohort to work through CV Check and get their people screening done. So each one of these expands our actual addressable market and moves them from the theoretical addressable market into CV Check addressable market, and it does lead to outsized growth. Our business is very resilient. What we've been focused on is getting a very broad spread and deep penetration into key sectors across the Australian New Zealand economy. You can see here that our sectors that we're predominant in have been largely unaffected by COVID or minimally affected. The other thing that we have is this revenue from a broad range of checks. So we have criminal history, bankruptcy, credit, referencing, qualifications, identity, and a range of others. And we provide all of this through one platform. So it's a multi-check, single vendor provision, and that's leading to us gaining market share. Through COVID-19, you can see here that we saw revenues dip in the region of 20 to 35% in that first period the COVID shutdowns across Australia and New Zealand. Revenues have since recovered from June to be coming in at numbers which rival our record periods of prior years. So we're quite happy with how we're positioned. It's come about through winning additional customers whilst our original customer base have seen their numbers decrease a little bit, and so it's more than made up for the gap. So quite happy with the team with that. So that leaves us, post this first wave of COVID and all the positioning around it, strongly positioned as we enter FY21. As I said, we're in the people screening and verification game. We've commercialised our technology and we've taken it to a blue chip client base. Our balance sheet is strong. We've been able to prove our management's capability through COVID-19, and we can show that this is a sustainable, growing organic business. And we have plans for FY21, which are quite exciting, and we'll be showing more of that as months go on. So just recapping, we have a small market cap, it's around 29 mil, strong cash balance sheet and a sustainable business. I think all of that comes at very modest valuation, so there's good room for investors to get on board about now. And that's a wrap. I'd like to open for Q&A, should we have some?
Our next presenter today is DomaCom, the first ASIC registered and ASX listed fractional investment fund in Australia. DomaCom has designed an asset allocation solution to investing in property with amounts as small as $2,500. CEO Arthur Naumidis of DomaCom will now dive deeper into the details of their offering.
Hi, I'm Arthur Naumidis, CEO of DomaCom Ltd. Before I start, obviously, what I'm about to say, general advice only, and no personal advice is being provided. So DomaCom has two key products. First is fractional investing. As the name suggests, investing fractions of specific properties or specific assets, primarily properties, but as you're about to see, we're extending beyond properties. So fractional mortgages, fractional debentures, and fractional equities. So we'll see that in a sec. The second product is DomaCom Senior Equity Release. This product enables people to sell a fraction of their house, and is definitely a product that's going to be relevant in this environment. That's called Equity Release. Now, COVID-19, from an operational perspective, the impact has been minimal to DomaCom because we operate in the cloud. We've been working from home since March, and so operationally the business is fine. So the key impact to DomaCom is more on the sales front, and so we've had to pivot the business to more COVID-friendly products that address particularly the vacancy risk. That's the key issue from a property investment perspective. And we've got three key areas there: rent to own, Islamic leverage, and downsizer for self-funded retirees, which I'll go into today. Now, we have three key product lines, as I indicated: fractional investing, investing in bits of assets; equity release, selling a bit of your home; and then lending, in other words, syndicating loans, either individual loans to specific properties or loan pooled mortgages as well. So they're the three business areas of DomaCom. The drivers, going forward, really are products that address the vacancy and pricing risk that's prevalent in the current market. And the key products that we're launching, not launching, but focusing on, rent to own, affordable housing, and national disability income scheme, insurance scheme properties. And then further to that, we're also targeting an Islamic home ownership product that enables people of Islamic faith to purchase property with the leverage, just as normal people will do, but without paying or receiving interest. So it's a very attractive product. And then finally, there's an element of the retirees that's really struggled in the pandemic, that's not benefiting from any government initiative. And this is the self-funded retirees who can no longer live on the income generated by their investment portfolio. And so our equity release product, according to the new ATO ruling that we received, enables them to top up their super. So that's the key focus of the business. So equity mortgage, as I indicated, it's a product that enables Islamic people or people of Islamic faith to purchase a property using leverage, just as non-Islamic people would, but without borrowing. And the opportunity here, we believe, is very, very substantial. There are 700,000 people of this faith in Australia, and it doesn't take many of those for our business to scale rapidly. And we believe it's a very, very innovative product, and it's a unique product. And we've, as you're about to see, we've got a partnership with one of Australia's leading Islamic organisations. Now, rent to own, very simple. We take a developer discount. In other words, developers pay 10% to sell their properties. We take this and divide it to a portion to the tenant to create a tenant incentive. And so what we do is we create 5% equity reserve in our sub-funds, and we allocate it to the tenant 1% per year. So they get 1% when they move in, and they get 1% every year after. And then the investors get the rest as a discounted price. Now, why do we do that? Well, this tenant incentive, we hope and believe, will result in our properties having a lower vacancy risk, because the tenants will choose our properties versus others that they don't get equity in. This creates it, it makes it an attractive investment to the investors. And the proof of this is we've just syndicated our first 2 properties, the first, both in Melbourne, the first during stage 3, the second, just as we speak, in stage 4. So, it shows you that investors are willing and believe that this product will work. So it's an attractive tenant proposition and investor proposition. And we've got a great pipeline, both in Melbourne and Sydney is where we're focusing at the moment. Senior equity release, as I indicated, this is targeting those self-funded retirees who can no longer live on their super, and they basically take equity from their house and put it into their superannuation. So readjust their personal balance sheet, and this has been given the tick by the ATO. Mid-August, we got what's called an administrative binding agreement, which confirms that this is the case. The investors are allowed to use the downsides of the legislation to top up their super using a fraction of their house. We're in a supportive landscape. Property investors are seeking lower vacancy risk. We've got products for that. We've got products for retirees. We've got products for the Islamic community. Banks have all withdrawn from SMSF lending, so we've got a product with automatic inbuilt lending. And housing affordability is also a major issue in Australia, and in this environment, it's just going to grow. So, we're positioned very well here. We have been growing, and as you're about to see, this growth is going to accelerate rapidly. Our pricing is very straightforward. Standard fractional pricing is 0.88, so 88 bips annualized of the value of the asset. But we're moving to a new fee structure where we charge 1% up front and then 0.66% ongoing. And what this does, over 5 years, it's the same fee, but it front loads it, so improves our cash flow now. And then we've got mortgage asset fees and cash. Our outlook, we believe, is very, very exciting, probably the best it's been in years. So our products are primed for growth. Our rent-to-own, affordable housing, senior equity release, Islamic products, all will, and we expect will work very well in this environment. And then on 4th September, we announced a transformative transaction where Ostagri, it's an agricultural roll-up owning paddock-to-plate businesses. It's about $300 million in valuation, and so we've announced that deal. And if successful, it'll grow our funds under management from $73 million to $373 million. But this will, as a fund manager, this will result in an additional 2.6 million fee per annum. Now, this is a minimum. Which will result in a $13 million fee over 5 years that we've organised. This is clearly subject to due diligence and shareholder approval, but also the reason why they've moved into why they want to move into our sub fund is because clearly they want to grow that asset. So we expect that fee to grow. We believe we've got a very attractive fee model. Our fees are based on funds under management, which is poised to grow rapidly. This is our corporate snapshot. Our ticker is DCL. Our price on the 8th of September is 9.5 cents. We have 278 million shares, which gives our market cap of about $26.4 million. And here's the disclaimer. Thank you very much.
It's my pleasure to introduce our final panel session of the day, titled IPO Spotlight. The panel will be discussing their individual journeys, challenges, and insights leading to their IPOs. Panelists include Brian Ward, CEO of Aroa Biosurgery, Andreas Forras, CEO of 4D Medical, John Kelly, CEO of Atomo Diagnostics, and moderated by Wholesale investor founder Steve Torso.
So as part of today, I mentioned that we're doing a special IPO spotlight session. And today I have with me three gentlemen that have probably achieved some of the three of the most successful IPOs during the COVID period. And for me personally, from a wholesale investor perspective, I'm quite proud to have each of these guys as part of this session, because we so wholesale investor worked with each of their companies sort of during the time, some earlier than others, some later than others. But welcome to you, Andreas from 4D Medical. Welcome to you, Brian from Aroa Biosurgery, and welcome to you, John from Atomo Diagnostics.
Hi.
All right, so just to start off with, I'll start with you, Andreas. Do you want to give me a bit of a background to the history of 4D Medical?
4D Medical is based on a technology platform called XV Technology that was developed at Monash Uni from about 2005 to 2012. And that platform, we believe, will be the next imaging modality really for all healthcare. But in the first instance, we're targeting that towards lung health.
Thank you. And yourself, John?
Yeah, so I'm a co-founder and CEO of Atomo Diagnostics. We're a rapid diagnostics test manufacturer that really simplifies point-of-care testing in both doctor office and consumer settings. And we've got a number of products on the market, including rapid tests for HIV, COVID, and others.
Brilliant. And Brian?
Aroa Biosurgery is a soft tissue regeneration company. We're based in New Zealand. We have development, manufacturing, corporate office here, but we also have an operation in the US. We have 5 commercial products in the US, and we're predominantly focused on very difficult to heal wounds and soft tissue reconstruction like hernia repair and breast reconstruction.
Fantastic. Now, to kick off with the questions, now I want to get on to sort of, I suppose, the plans, direction forward sort of down the track. But just to start with, once again, I'll start with you, Andreas. How would you describe your journey over the last sort of 4 to 5 years sort of leading up to the IPO?
It's been really, I think the only way to describe it is as a roller coaster. I think for us, the key feature of our existence, before the sort of the second half of 2019 has been about survival. It's been about availability of capital to continue on to drive the business forward. And I think, as we've gotten through, de-risk the business and validated it in sort of some very public ways, that's really very rapidly transitioned around for us. And we've now been able to get access to the capital, and firstly a good pre-IPO late last year, and then the IPO this year. And we're now finding ourselves in a position we feel very excited about our ability to go out and execute.
And just in that journey over the last 5 years, I know we started working with you, I think it was around sort of 2015, 2016. Like in that lead up, I know you not only raised money from Australian investors, but where else did you raise money from in that process?
Look, the vast majority of the money has been Australian, but we've certainly raised capital in Singapore and in the US as well. We had some. I think we had a little bit of success in Hong Kong as well. So really, we were casting a wide net to bring investors in who would believe in the mission, especially, as I said, in those early days when we recognized we had a high risk profile because we didn't have all the evidence in hand yet about the product.
Yeah, and you did the true founder style. You put everything on the line, left a comfy, nice cushy job, and come out and sort of commercialize 4D Medical. So it's a fantastic story. Now, Brian, we initially come across you, I think it was like 2012, 2013. And as CEO, I think it's been a journey for you over the last 10, 11 years. Is that right?
Oh, absolutely. I mean, we've, obviously the company's changed a lot over the last 10 years. I mean, I was with the company, and we've gone through, a little bit like Andreas. I mean, it's been challenging over the last 10, 11 years to raise the capital to move the company forward. I mean, we've been really lucky. We've been supported really well by both investors here in New Zealand, angel investors initially, then venture investors, and then, lucky enough to attract a little bit of money out of Australia from institutional investors along the way. So it has been it's been quite a, it's been a roller coaster, but we've managed to build the company over that time.
And how did it feel for you? You've all mentioned you've mentioned this. Haven't got onto you yet, John, but you mentioned about the challenges of raising capital earlier. How did it feel to all of a sudden have the attention of the market and be inundated with offers as you're going through the IPO process?
Yeah, certainly, quite a change compared to earlier times. So, we had a fantastic response to the IPO roadshow, and huge amount of demand. So, really happy with how that panned out, and definitely quite different from my previous experience.
Good to hear. And John, I can't remember when we go back to. I think it was around about sort of 2015, sort of 2016. So, how and I said for you on your journey, how have you found it as far as your process leading up to IPO and some of the people you've been able to attract in that journey?
Yeah, I mean, we for the last 4 years, we've really sort of transitioned out of R&D into regulatory and commercial activities. So we've started to try and validate the technology and start to secure some partnerships. That's been really helpful. The shareholder base, we've been really quite fortunate. We have Lang Walker, Alan Moss, the Global Health Investment Fund, the Canadian government, and we've had Gates Foundation. So we've had a really good register, and I think that's helped with the attraction from high net worths and more recently through the IPO, a lot of institutional. And we've raised probably about a third of that money in the US and Europe and in the UK. So it's been good to have that international register from early.
Interesting. Brian, did you raise any money outside of Australia and New Zealand?
Not as investment, but we did early on. We did a number of partnerships with US-based corporates, and that been really sort of fundamental in terms of financing the company.
But each of you, I imagine, spent a lot of time overseas. Like I know, Andreas, most of the times we're communicating, it's sort of you're in the US. And so how much time would you spend overseas, even given your sort of Australian, New Zealand companies?
Well, I'd probably do 4 trips around the world every year. So 2 to 3 months offshore, obviously less in the last 12 months. I mean, a lot of air miles, but we've recently invested in some executives overseas to try and make that overseas growth more sustainable.
Yeah.
I mean, for me, it's varied a little bit year by year, but in some years I'd spend 4 or 5 months in the US. So now not so much as we've got a US-based team, but over the years I've spent a huge amount of time there.
And Andreas, you actually moved to the US.
Yeah, that's right. I mean, I still spend half my time or so in Australia, and so I'd be spending something like until recently, of course, maybe 6 months a year on the road, and about 5 or 6 months of that in Australia and a month overseas, in various other places. So certainly been a huge amount of travel. We have very proudly have our all of our internally facing stuff in Australia now, well embedded, but the markets, both customer markets and investment markets in the US are hard to ignore.
Mm. And you mentioned, Brian, that you received sort of venture money out of New Zealand. Curious for you, John and Andreas, did you guys sort of speak to Australian VCs in those early days, and did you sort of receive backing from them, or was it mostly from sort of high net worths?
Well, for us, the early day funding was we spoke to, I think, all of the usual players in the Australian VC scene, and we weren't able in those early days to attract any of that VC money. And so we went through a reasonably kind of standard startup progression of, angel investors, high net worth, family office funds. And that was really the case for us up until the end of last year. So, we only brought on institutional investment at the end of last year, and then in the IPO.
Yeah, no, we had some preliminary discussions, but for us, venture capital was a last resort. The term sheets are generally pretty onerous, and some of the provisions in there, not ideal from the founder's perspective. So we much preferred a high net worth and institutional pathway.
And to be honest, what I love about each of your stories is I'm sure for a lot of your early investors, you guys each represent a 10x plus return, which is something that's it's what every, I suppose, investor tries to chase, and you guys have been able to produce that for your shareholders. So well done. I suppose the next question I'd love to know, so that's sort of leading up to the sort of IPO process. How has COVID, and we can start with you, Brian, how has COVID sort of either impacted from either accelerating or sort of decelerating your sort of IPO plans?
Yeah, so we had planned to launch the formal book build late March, and so we were all set. Pretty much had all the institutional investors lined up, and we were very close to locking that in. When COVID struck, then we had to pause, and so for us, we paused through April, May, so we could get certainty about what was going to happen with our run rate. We saw that things started to stabilize, and then we relaunched our IPO and then listed in July. So it was a pause. It was a situation where we had to kind of reassess what was happening and then push forward with it.
And how is that for you as a CEO leading the charge?
Yeah, not ideal. Would have been good if it was a straight shot, but yeah. Look, I mean, it was. I think it was a very uncertain time for everyone in April, and so it was good not to charge ahead. And I think the way it's turned out, we've been pleased with how it's gone subsequently.
I was going to say, John on the other hand, started getting warmed up at that stage. And hats off to you, John. I think you were one of the first IPOs to go, like, if you think about that early March period where there was sort of chaos and everyone, markets were dipping and everyone was freaking out. From my memory, you were one of the first IPOs sort of off the shelf. So how was that experience for you?
It was difficult. So we listed in the middle of April, and we closed our book at the end. From when we first started the book to when we closed the book, I think the ASX dropped 35% in that 3-week period as we were trying to close out the book build. So, obviously under enormous pressure. We still had a lot of support from investors to do the IPO, and I think in part because, our products are rapid test products. Yes. So I have a very sizable COVID business. So there was always kind of a counterbalance to the chaos, and this is the type of technology that's, here to help with COVID. So I think that resonated with investors, and we were able to kind of stay the course, but it was obviously pretty difficult. I think we were the first company to list through that sort of period. And
you were. I couldn't believe it when I saw the news that you were going to list. I thought that is so brave.
There was people saying or calling, "You still doing it? Are these guys really going to try and do it?" So I think we did the first virtual listing from my kitchen table. Little bit of history. It was good.
Well, mate, congrats on having absolute nerves of steel for doing that. And Andreas, your journey?
Yeah, so we actually somewhat miraculously, really, fortunately, everything was just pretty much went to schedule. We had the view that we'd like to list, before reporting season. And we set ourselves a deadline of we'd need FDA by a certain date in order to get all the IPO away before reporting season started. As luck would have it, we actually got the announcement precisely on that last day of our window. And so we commenced with the IPO, sure, in amongst the thick of COVID, but, I guess towards the tail end. And, so we were later on in the chaos than Brian and John, but at the same time.
Were you quietly thanking him? Were you quietly thanking Brian and John for going first?
I think it was certainly great to see a couple of really successful IPOs go out there, ahead of us. That I'm sure that helped calm the markets a bit for us, and also the other factor is that we're a lung technology, so we're sort of really focused on the lungs, and we think that we can be a big part of that solution. So really, fortunately, we were able just to stick to plan.
Fantastic. And going back to you, Andreas, like how much did you end up raising as part of the IPO?
So we had a primary of 50, and in the end, we thought we were going to sell about $15 million worth of existing stock, but there was actually no one wanted to sell, so we did about 5.5 of secondary plus the 50 of primary. So, yeah.
And what are some of the next major milestones that you're targeting?
Well, you know, for us really, it's about getting into the market. We do have some revenues, but they are on you know, our early versions of our product. You know, we're now we have FDA clearance for our, you know, that first FDA clearance for us. It's been fantastic because it's broader than we were hoping to get. FDA has really cleared us for any use in the lungs, which is exciting. And, you know, so it's about taking that to market, having the R&D, the clinical trials back up a sales and marketing team to really get product out into firstly the US and then Australia. And, you know, that should keep us and everyone pretty occupied for about a year or so. And then hopefully after that, we'll be ready to launch our second product.
Fantastic. And Brian, how about yourself?
Yeah, so we raised 45, and that was 30 million plus, 35 million plus a $10 million secondary. You know, in terms of our plans, I mean, it's very much about commercial expansion in the US. So, you know, we have a good portfolio of products there. They're very early in commercialization. So, you know, a lot of that capital will go towards building out that sales team. We have a ramp happening in our business generally, so we'll also be investing in more facility and more manufacturing capability. So really those are probably the two key investments for us.
Fantastic. And John?
Yeah, ours was all primary. We took in 46 by way of a pre-IPO and an IPO, and all the founders and principals escrowed through that process. So we're looking to build long-term business. For us, obviously, TGA approval of our COVID test last week. Very exciting. We're now looking to roll out locally. We announced a very big deal with a listed company in the US to take our test with them to the US. So we're looking for some expansion into the US and setting up a sizable US business now. So yeah, busy year ahead.
Is there any more you want to give some sort of explanation for the product and how that's sort of relevant right now, especially for the US, given how many cases they have?
Yeah, I mean, our technology is pretty simple in its concept. We take a sort of bits in a box year 12 chemistry format, which is ubiquitous in the market, and we've developed an integrated consumer-friendly version. So it really makes sense for point of care deployment, pharmacies. We're the only company with a test in Australia that's approved by the TGA for HIV self-testing. So really sort of, you know, captured that consumer-friendly market. And I think for not so much in Australia, where it's still very much lab-based test and trace. In the US and the UK, you know, they've lost control of that. Now it's about population management, and obviously tests that can be deployed in pharmacies are critical to that. So we're very excited about the opportunity and being able to play our part, hopefully managing the pandemic somewhat.
And one thing I've always wanted to ask you, John, how on earth did you get the Bill Gates Foundation behind you?
Well, we came up with this concept, and we explained to them that it could really transform testing in global health, because a lot of people don't want to go to facilities or they can't get to a facility. So they backed us to develop a platform for HIV self-testing, and we developed that. We launched it in Africa. We also got it approved locally. And then off the back of that, we were able to pivot into COVID quite quickly. So we now have the same user-friendly test now delivering COVID solutions globally.
Fantastic. And once again, I will highlight, like I said, what I also love about the role that we have is that not only seeing what you guys can do as founders and how you can sort of build and then execute on businesses, but the fact that it's Australian and New Zealand innovation that's actually playing in a world stage. Like, that's something that's always sort of excited me about that. And I don't think people, until you actually go overseas, you don't realize how much credibility that does actually get when you've already got some sort of traction or in your own marketplace. And just to sort of finish off for this, the one last question I have is, and I suppose this is a discussion you can have with the sort of investors that are watching. So for you, Andreas, what are some of the long-term ambitions that you have for 4DX?
Look, I think, you know, I think we can take our technology, we can expand it from the lungs into the heart and into cancer. And I think our XV scan can be, I think, the next generation scan following on from CT and MRI. I think we can be a global player in medical imaging and I think really make a big difference.
Fantastic. And yourself, John?
Yeah, I mean, I think, our solution, we think, can really transform point of care and take testing out of the labs and out of hospital settings and make people more empowered to test themselves and take responsibility. I think the pandemic's shown that's needed. So, hopefully our technology now can help deliver some of that opportunity to the market, and also to some well-intentioned applications in global health as well.
Well, it's definitely a trend, that's for sure.
Yeah.
Sorry.
I was going to say, it's a trend that the pandemic's only further validated now.
Yeah. Correct, and that's a common. I suppose it's a common theme that trends that were already sort of taking place have literally just accelerated years, which is fantastic. And Brian, to finish off with you, what are some of the longer sort of term ambitions for Aroa Biosurgery?
Yeah, look, we believe that we can create a world-leading regenerative medicine company, and we have a technology that's a very good platform for that. The other thing that's really important with our technology is it lead to better healing outcomes for patients. And I think for us, patient access is really important. And so allowing many more patients to benefit from regenerative healing.
Fantastic. Well, gentlemen, I'll finish it there. I want to say thank you very much again for your time today. And I know I've said it already once before, said congrats to all of you on what you've achieved during these, not just these last few months, but just over the last few years. I absolutely know how long and arduous the journey is for each of you and what you've been able to do, from the capital raising to the commercialization to the building of your teams to having offices in different countries and so forth. You guys have really, I said, just been impressive in the way in which you've been able to achieve what you have. I recommend everyone go on, whether it be your trading platform, whatever that may be, go onto each of their websites, follow what they're doing, follow their progress. I said, each of these companies are impressive in their own right, and I highly recommend you follow them. Thank you again, gentlemen.
Thank you.
Thank you.
Thanks for the opportunity.
Thanks, guys.
Thanks, Steve. Always a pleasure.
Have a good day.
Bye. Bye. Thank you for joining us for today's Small Cap Virtual Showcase. I hope you enjoyed, obviously, the companies which presented, but also, the panel sessions that we set up for you and the keynote talks. For us, I'm very appreciative for the participating presenters that not only gave their time, but also the energy and effort they went to participate in today, and obviously to the keynotes and to the panelists as well. I said, for us to be able to bring these to you and be able to bring their insights, it's just such an important part of building an ecosystem and also adding value to you and your investing habits. So thank you again. We look forward to seeing you at our next event. Now, our next event is going to be on October 2nd, and it's going to be our normal sort of investor virtual showcase. And it'll also be featuring a range of private, pre-IPO, and some small cap listed companies as well. So we look forward to seeing you on October 2nd. Have a great day, and thank you again for joining us.